Every day appears to be a new normal since that fateful day in March 2020 when the first of a series of lockdowns was announced in a clarion call to vanquish an unseen foe that was visible in its effect on our daily lives. We beat on, both against the current, but still seem to be pushed back ceaselessly in the past, with each successive wave of COVID-19 pandemic bringing us close to parting the clouds of gloom, only for a new variant to appear on the horizon and cast a shadow on opportunities that could lift many to a better life. But if there's one thing that is human about us, it is in the immortality of hope that hides deep within the inches of our soul. We kept our face to the sunshine of a better tomorrow as vaccines helped us battle the demons from Delta to Omicron and look past the shadows of our trying times to step into a brave new world where hybrid or remote work kept the digital world ticking in a digital avatar. As we set our sights on the future, can talk of wealth be left behind? The scars of a time when the loss of a job or even an entire business or a sudden jump in medical expenses to save the lives of family are still fresh for many. We have seen volatility in the markets like never before, spanning a record breaking rally last year to remarkable turbulence at the start of the current year. As we have just passed the unveiling of Budget 2022, which seeks to establish steadiness and predictability, it is perhaps time to reflect for ourselves on the days of future past and resolve to ensure that we, as captains of our fate, steer our financial life to stability and prosperity, guided by the rays of knowledge. On that note, good morning, ladies and gentlemen. I'm your host, Gautam Srinivasan, and welcome to Nivesh Mahakumbh 2022, a grand, one of a kind, award winning event where the best minds of the industry come together to share their insights with you on financial lessons from 2021 and the way forward in 2022. This special presentation also celebrates Azadi Ka Amrit Mahotsav, which is an initiative of the Government of India to commemorate 75 years of progressive India and the glorious history of its people, culture, and achievement. To take the day's proceedings further, I'd like to invite, or rather introduce first, Mr. K.S. Rao, who heads Investor Education and Distribution Development at Aditya Birla Sun Life AMC Limited, to talk about the purpose of this mega virtual event and share more information on investment awareness initiatives. Good morning, Mr. Rao. It's over to you.
Thank you so much, Gautam. Thanks for this lovely introduction and great words. Thank you so much. And good morning to all the audience. And thanks for taking time to joining us today. And before we start our proceedings, it's a custom and it's a tradition. We all invoke the divine. And here is a song, a prayer song to invoke the prayers to the divine. Make this Nivesh Mahakumbh and all your investments great. Let us pray.
आदित्यः सविता सूर्यः खगः भूषा गभस्तिमान् सुवर्णसदृशो भानुर्विश्वरेता दिवाकरः
Welcome back. Indeed, prayer to the divine, which always gives you that kind of peace, and it's all to start with a good beginning. Thank you so much for joining. And this is the Nivesh Mahakumbh, is uh, very, I mean, as Gautam said, it's one of those award-winning initiatives, and we are glad to be here with you. Every 4 years, I would like to brief about a Kumbh Mela which we go. I mean, probably some of us we have surprised. What is this Nivesh Mahakumbh Award? And some of you are joining for the first time. May would like to know a little more. I would like to narrate a bit about Nivesh Mahakumbh and story behind. Every 4 years, millions of Indians go to these holy rivers, and that's called Kumbh Mela, take a holy dip, and there is a belief that they purify the soul. And this is a spiritual experience like no other in the world. At Aditya Birla Sun Life Mutual Fund, it's our mission, and it's understandably, of course, more material, but we pursue this with no zeal less. And this is our investor education outreach program, which is started way back in 2015 from the Jabalpur. And today it is the 26th Mahakumbh. And this outreach is as good as the scale of a Kumbh Melas. And this is also a reason why we call Nivesh Mahakumbh. And it's somebody who take a dip here, probably not exactly a ritual of a dip, but it is about understanding dip. It is a DIP. This is into a sea of financial awakening. This will end the ignorance that stands between us and between what is that financial security. This dip, which offers to us participants a powerful holy dip kind, and this is a dip which makes the holy trinity of DIP. Let me take a minute to explain what is that DIP. DIP is it's a D is a delayed gratification. Delayed gratification is fundamental to the principle behind making our sacrifices of today to enjoy for better tomorrow. I is an impact of inflation, and P is the power of compounding. And power of compounding is always a joy of compounding, and we call eighth wonder of the world how it can make difference. If someone understands this DIP, I think we are understanding the entire financial literacy in a well. And this is the time of the digital Mahakumbh coming to you. I mean, last couple of years, as Gautam was talking earlier, we moved from the virus to vaccine, we moved from the COVID to COVID, we moved from the recession to recovery. There is a growth. And this is coming to you on the day, just 4 days after the budget. And it's the first Saturday of the budget. We can just look at what union budget can do for the nation, do for individually for us. And this is a month of February, which is called a month of love. We celebrate on 14th of Valentine. Probably how much today's sessions can help us to make our life very lovable, and we can do something very different. And today is another unique day. It is a Basant Panchami. It's a Saraswati Panchami we celebrate, and it is to the reverence to the goddess of learning. And today, indeed, to put it in a perspective, you are getting the theme very right. It is a reflections and resolutions. Reflections of what has happened a year or a year before, and resolutions what we can do now. And this is going to be an event of learning, event of education, and this is an event which can make how the union budget and what is your personal budget, how your personal finance, how your long-term goals, and all that lead to a prosperity. And it's called in the budget, we spoke about Amrit Kal. I mean, Honorable Finance Minister was talking about next 25 years, India 75 to India at 100. Probably it is each one of us for the next 25 years, how we can look at what is that Amrit Kal. And I look at the reflections, like, reflections of the past COVID-19, or we call, recently, as we are currently undergoing, and most of us, including me, I mean, some of us would have impacted with this Omicron. We don't know whether it is a wave one, wave two, or wave three, but what is that reflection for us is world can change in a day, and we are stronger than what we believe, and we have emerged very stronger. And of course, this last 2 years has told us something more important. Already, most of the times we have heard the word of health is wealth, but it is proved that health is truly wealth. And it's a wealth is most important, and we can't ignore, and wealth needs a careful attention. And of course, what it meant to us and the reflections, emergencies can come anytime to us, and wealth needs attention. At the same time, emergency funds are the most important. And what it is taught to us, tough times or always gives the way to the better times, probably crisis into an opportunity, and it's a never waste in a crisis. And with this in mind, what is the resolutions we can look at? I mean, we need to let go of the past, and we need to have our risk management right, and we need to step up our savings, probably step up our investments. We call step up SIPs. And just go back and check at the end of the day, do you have a proper will? Have you nominated for everything? And the today's session, we have very interesting line of speakers, which will create this theme very right for you. There is going to be a keynote speech on the budget and how the budget can impact us from our MD and CEO, Mr. Bala. and there is going to be we are going to learn about bygone lessons, and what is that fireside charts. We can look at how union budget is impacting the markets and personal finance from our CIO, Mr. Mahesh Patil. And it's of course the time we are changing the way we invest. It is active and it's a passive funds. How can we be active on the passive or passive on the active? What is that can change? There could be a detailed discussion about the panels around that. And one goal which cannot change whether pandemic or no pandemic is our important long-term goal, which is our retirement, which is most important. How do we reimagine our retirement? What is that we can do very differently? And last Nivesh Mahakumbh Digital, thanks to HT Media, on August 14th, we launched our new initiative called For Her to educate women, educate every woman in the country. And it was very successful event. We are embarking on that mission. But way forward, what is For Her? How the woman can take a decision of investment, and its woman is educated at home. You are not educating one person, but the entire family is being educated. Well, let us look what is the perspective. And today, I mean, last 1 year, we are looking at millennials actively participating into the markets. What is that millennials can look at money now, whether it is a crypto to anywhere, and what is that they need to learn? And fire is the one they look at. What is the fire in them? The financial independence and retiring early. But is it possible? And this Gen Z, how they need to invest differently. We are very interesting panel. Last but not the least, it is the period of Amrit Kal we are talking about. It is a 25 years of long-term investing. And it's like, this is for me, Amrit is AMRUT, that Amrit Kal for us to invest rightly. That Amrit could be A is, it's the right asset allocation. M, I always say mutual funds IA, and which mutual funds IA you need to choose. And R is you need to look at your risk management, your ability to understand risk and ability to manage risk and ability to undertake the risk that can define. U is an understanding, your understanding of yourself, understanding of your finance, understanding of the market, and upgrading and upskilling yourself. Last T is one need to take action. It is not just attending the webinars or doing something. Am I right on my financial path? I think if we can do this AMRUT right, Amrit Call is here for us. Before I conclude, I'd like to take you around. What is the Nivesh Mahakumbh about? A quick AV we can run around.
Every year, millions of people take a dip in the holy river Ganga to wash away their sins and to pray for their well-being. At the annual Nivesh Mahakumbh of Aditya Birla Sun Life Mutual Fund, thousands of eager investors come to take a dip as well, but a dip for their financial well-being. A dip that teaches them the power of delayed gratification, the perils of inflation, and how it slowly impacts the growth of their wealth and the power of compounding. An investment concept so powerful that is often described as the eighth wonder of the world. The one who truly understands the power of dip may forever be free from financial stress. A unique, one-of-its-kind initiative in the mutual fund industry. Nivesh Mahakumbh is the largest confluence in India of the finest investment experts and thousands of existing and new investors. Just like the Kumbh Mela, Nivesh Mahakumbh offers an immersive experience. It introduces participants to key mantras of successful mutual fund investing. Mantras that lead to holistic life planning. Mantras for financial liberation. What makes it engaging and immersive is also the innovative use of skits, games, and technology. With changing times, financial management has also assumed a new definition. After the success of our first mega virtual event, with numerous esteemed speakers and millions of viewers, we are going digital again. If financial liberation is your goal, join us in the annual pilgrimage of Digital Nivesh Mahakumbh.
An investor education and awareness initiative by Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
With this, I'm sure you got what is the Nivesh Mahakumbh glimpse. I would like to invite now our MD and CEO, Mr. A. Balasubramaniam, to deliver keynote address. Mr. Bala, who is having a very rich experience in the mutual fund industry with over 26 years of past experience, and he is founding member of Aditya Birla Sun Life Mutual Fund. He is a visionary for us, and he is the guide. And Nivesh Mahakumbh is his brainchild. It is privilege to have Mr. Bala here and to understand what the implication of budget and what is the broad message. And Mr. Bala is also a chairman of Association of Mutual Fund in India. And welcome, Mr. Bala, over to you.
Welcome to all of you to be part of Aditya Birla Sun Life AMC Investor Education event in Nivesh Mahakumbh. I'm happy to share with all of you. This is our 26th Nivesh Mahakumbh Investor Education program that we have been carrying out all these years to educate investors across the country as to how they should go about managing their personal finance, investing in capital market, particularly to the mutual fund. Again, I'm happy to share with you this is the second digital Nivesh Mahakumbh that we are doing jointly with HT Media. Again, thanks to HT Media to be our partner in the journey of educating and empowering investors in the country to manage their money very efficiently. As I speak today, just 2 days back, we had our budget. Clearly, the budget, as all of you would have read in the newspaper and multiple news channels and any other mediums, you would have realized the budget is actually drawing a roadmap, not just for 1 year of 2022, even beyond 2022, and paving a path for the next 10 years. Not even 10 years, next 25 years. The 25 years come from the back of India completing 100 years of independence. On the base of that assumption, the government of India has thought about building the various infrastructure, includes urban infrastructure, digital infrastructure, making the education system more robust in the country. Again, education is something the government of India has given very high focus. I'm happy to share with you in today's session what you are going to speak is on educating of everyone to invest in mutual funds, to manage their personal finance. That would be the most essential to everyone to meet their longer term goal needs. Me being part of the capital market the last 30 years, we have seen many volatilities coming and hitting the market. Sentiment will go up and down. The outlook will go up and down. The mood of the people will again change. And not just only in India, even internationally. But one thing has remained constant in all these years, the change. Change has remained constant. Second, what has remained constant is the upward territory of the Indian equity market has also remained constant. The reason why I'm saying the upward territory in the capital market with the equity market has remained constant. When I started off my career in the year 1990 or maybe 1989, the index was somewhere close to about 800 or 1000. Sensex I'm taking, which is the BSE Sensex. Today, the BSE Sensex today trading at about 58,000 index. In fact, when people ask me about 4 or 5 years back, I'm sure all of you also would have asked the same question, would have heard about it. Predicting index to 50,000 index, 50,000, not everybody was taking a bet, and nobody was willing to actually take a bet it will become 50,000. At the same time, everybody was hoping it will cross 50,000. Exactly that's what happens in the capital market. Every 5 years, you start thinking that market will go up and down. Investment is like that. Investment in like that in mutual fund. Likewise, you need to give a lot of time for the investment to fructify in terms of real return. And that's why I think one has to make the investment. And second, the mutual fund, again, I've done a great role in the whole piece in order to ensure that each of the individuals are able to use some vehicle for making their planning for investing in the long term. And therefore, that's something. The mutual fund vehicles now become an established vehicle Many times we may go and search for options, having options within my own pocket. The what is there in my pocket is actually is it mutual fund investment is something is there in my pocket all the time. Therefore, making that full use of it and making the investment will also be extremely important for every investor should know. And third, from investors' point of view, of course, I would assume in today's audience, the digital medium, given the fact that all of you have come the digital medium, you are in some sense would be a mix of savvy investors. I'm sure some of you would have never invested in mutual fund. Some of you must be investing in mutual fund, but you must be keeping redeeming and investing in back and so on and so forth. Right time the market. Some of you would have come with the clear vision for staying invested for long term, but market का ऊपर नीचे देख के डर के शायद पैसा निकाल भी दिया रहेगा. But many such investors are there. There will be some investors who would be continually holding the investment and really enjoying the fruit of that benefit of staying invested for long term. You have a mix of investors. For all such investors, first and foremost, how to actually have that conviction that I'm investing in the mutual fund for some purpose. That is where we all have created a beautiful vehicle, which is a wagon, we can call it, to fulfill your dream or maybe need. I don't call it a dream, I call it a need. The need comes first more than the dream. And that being the case, clearly, the wagon that you have created to fulfill your need is the SIP is the wagon that you have created. I think all of you who have been investing in the market, in the mutual fund, the best way that you can put your money into some vehicle that can generate the return that will meet your longer term need. That's something SIP is the best way of investing. Is something I would again reiterate. It's again simple. When yesterday only I heard a conversation with one of the technology companies guys. He made one simple analogy that creating a simple user interface need to undergo a complex structuring on the behind. One gentleman, a very old gentleman, used to always tell me, part of the NSE National Stock Exchange, in early part of my career, all of us as a user of the car, we never ask a question to the Maruti or any other companies that how do you make your car before you start driving it. We buy the car, we take the key and then start driving it. Never even bother actually that what are the things that has gone inside to make that. Believe me, mutual fund take care of the manufacturing part. The mutual fund, we take care of the in-house wiring, in-house processing, in-house capability that we have in managing money efficiently. Therefore, for you to onboard into the mutual fund like a key that you take from a car, for you're buying a car, the key that you have to take, and the SIP is a key that you must take, and that's something you must continue for longer term and drive as far as possible, as long as possible, that you can drive to the SIPs. That's something as a principle that one must do. And again, making it simpler for people to understand, given the fact that most of the time all of us would ignore what is the most simple things to follow. At the same time, try and search for something innovative, something glamorous, something would be looking different from my investment point of view. Believe me, investment is so simple, but kuch bhi mein karenge, clearly, the investment would be delivering GDP plus nominal GDP plus 2 or 3%, and that's being the case. Any investment that you go and chase, you can't expect more than this. Therefore, if you keep your expectations realistic, on the basis of which you make your investment through the mutual fund, SIP is the way of investing. And also believe me that the cost aspects which I mentioned earlier, an example, all such things can be taken care. At the same time, the need that one has for meeting their longer term purpose also can be fulfilled through the mutual fund. I'm happy to be part of the opening session today. I'm sure you'll have series of interesting lineups in the coming sessions. I think we'll talk to you more in detail about the investment world, particularly the mutual fund industry. We at Aditya Birla Sun Life Mutual Fund are extremely committed in upskilling the existing investor base and new investor base, and then give them the benefit of understanding. Therefore, that understanding increase helps you to manage your money efficiently in the long run. And I wish all the grand success for this today's conference, and look forward to seeing each one of you as an investor in the mutual fund as well as Aditya Birla Sun Life Mutual Fund. Thank you.
Thank you so much, Mr. Balasubramaniam, for that insightful keynote speech. And of course, thank you to Mr. Rao as well for taking us through what the Nivesh Mahakumbh stands for and how it seeks to benefit investors by providing them the rays of knowledge that I was speaking about so that they can steer their financial life to a better destination. All right, time now to start off with our first panel of the day titled Bygones and Predictions, Lessons in Finance from 2021 and What to Look Forward to in 2022. Well, let me set some context. The past year, well, it brought about major shifts in the realm of money management with the pandemic's continued impact on our daily lives progressing. A tumultuous first half, followed by calmness for a few months before renewed fears and uncertainty due to the Omicron variant of the coronavirus. And there have been lessons learned, unlearned, and relearned. And going forward, these changes will continue to govern a greater part of our lives. On the brighter side, the stunning gains made by the Indian equity market despite the pandemic blues was one of the high points of 2021. India's benchmark stock indices surpassed several milestones. Here's one: the BSE Sensex reached an all-time high of 62,245 points in October and gained around 10,000 points in a single year. That's the highest year-on-year increase in absolute terms historically. Now, considering the ever-shifting investment landscape, it can be baffling for investors to gauge the winds of change accurately. Our first panel discussion at the Nivesh Mahakumbh 2022 focuses on the financial lessons that 2021 taught us and what we can all look forward to in 2022. Joining me on this panel are Dhirendra Kumar, founder and chief executive officer at Value Research; Harit Kohli, associate director at NatWest Group India; Amit Biwalkar, managing director and CEO at Sapient Wealth Advisors and Brokers; and Bhupesh Bameta, fund manager at Aditya Birla Sun Life Mutual Fund. Gentlemen, welcome to this special presentation, this Nivesh Mahakumbh, as we seek to provide investors with the wealth of knowledge so they can steer their financial ship to safety and to better destinations. Thank you so much for joining us. Well, we've just passed the budget, so the obvious question to all of you will be your initial impressions of Union Budget 2022. Dhiren, we'll start with you.
Yep. There wasn't much for investors to actually take note of. The only notable thing was that we are doing okay. It was almost like an update that we are doing okay. I think one thing which happened, which is quite significant for speculators, and most investors will get distracted by that, which was, the taxation laws pertaining to digital assets. And that is something which investors should be wary of, because it gives a sense of, this is a very volatile asset which has come into being in the last 1-2 years. I have not been able to understand what drives it, and my understanding historically has been that keep away from something which you don't figure out. So, but many investors will get attracted by the wildness of and look at it as an opportunity. And the budget gives a sense of legitimacy to the whole framework. So be wary of that. Ask your basic question. You don't get into it if you don't understand that.
All right. Well, this was a budget which was proposed to bring in stability and predictability. But considering the times of easy money are going off, let's see how much stability and predictability we can bring. Considering January 2022 hasn't exactly been a calm and steady period for the markets. Meanwhile, let's move on to the table around the table and hear their views on the budget. Amit, your thoughts on this on budget 2022?
I think the government actually gave you a roundup of what they intend to do over the next 10, 20, 25 years. And a sound budgeting exercise is actually key success to your financial plan. So, as a country, they have put down the roadmap as to what we have to see in the next 10, 15, 20 years for India. As Dhirendra mentioned, we started with not accepting digital currency. Then we came to putting up a committee. Then we came to putting regulation around it. Now we have said that we'll launch digital rupee. So I think the government is also accepting new ideas and new technologies. And Gautam, the important part is that this new age technology companies or the ideas what we have to pay a lot more attention because I know we know Mumbai today now as Kamla Mills compound or Peninsula compound, but all those were textile companies once upon a time which were listed, and today they are not there. We have seen leasing finance companies like Siet and others which are not there today, and we have new age companies. So the government also has realized this, and they are forward looking. I feel so that what will upset the apple cart is clearly if interest rates move up too quick, uh, and along with that, if we don't have growth, that is one road bump which I see, which investors should watch out for. That's my take on it, Gautam.
Absolutely. And it's always that growth versus inflation fight. And of course, looking at where the fiscal deficit figures are, it'll be interesting to see how the government manages to bring things under control. Harit, meanwhile, your initial impressions of Union Budget 2022.
Good morning, Gautam, and thank you for having me on the panel. A quick disclosure, the views I'm sharing are personal and in my personal capacity. That said, I think for me, the biggest takeaway was that fortunately we didn't go overboard on any of the populist measures, given that, we are heading for elections in some of the states, which are some of high stakes for some of the parties. I think that's a big relief for me. Having said that, I would have personally, we've gone incremental. The government is trying to do a lot of things, but those are kind of incremental steps. Given that we've got an absolute majority in the parliament, I would have really liked to see a paradigm shift. Three critical areas where I personally would like to have seen some initiatives in the budget. First is defense. Uh, our allocation as a country to our defense as a percentage of the GDP, given the kind of constraints we have on our neighborhood, is way low. And we all want a very well-doing country, but that comes in a state where you have safety and security at your borders. So capabilities can't be created overnight. It takes vision to do that, and I would have really liked to see that. And there's a spin-off to that. It would have helped you both in terms of security, but also increasing your production capacities, R&D capacities, which have a spin-off effect on jobs and forex investment. The second critical area where I think we really need huge investments is health. Like you rightly said, last year was an eye opener, and it's clear that our health system is not able to cope up with the kind of things that are happening. And there's no saying that COVID is gone or there won't be anything else like this. So we really, really need to rethink on a national health policy, which will again have huge spin-offs both in the job creation space and the capex space. And third would be on the whole concept of job creation. I think our biggest challenge as a country today is a vast population. It's a demographic dividend, of course, to have a young population, but then we also need jobs for them. We focused a lot on, let's say, infrastructure. We do need good roads. We do need lots of bridges. But there, if you see, majority of the labor force is in the unskilled arena. Now, if you, let's say, move to something like shipbuilding, where you need a huge initial push from the government, but then you can upskill your labor force and move them from the unskilled to the semi-skilled or more skilled area, that then one increases your per capita income, which will help you with higher consumption going forward. So it's a very virtuous cycle which will help the economy, but that then needs that vision to come through in the budget.
All right, three very important points indeed for the government to look at: development of the defense sector, and of course, development of the healthcare infrastructure, which has been, which has been a priority area for a long time, but still needs a lot of development. And the demographic dividend, which you mentioned, that's going to be key, especially as a huge amount of young population needs jobs, and we need to make sure that those options are available as we recover from pandemic induced boost. Point taken, Harit. Bhupesh, we'll come to you on your thoughts for Union Budget 2022.
Right. So I think it's a good attempt to focus on long-term growth. Given the fact that we had elections, also there was some fear that it may turn out to be a populist budget, but instead, government chose to focus on capex and on capacity building. Over the last 3 years, this is what government has been doing, and what we see is that the total capex outlay by government of India has doubled in 3 years. This is perhaps one of the first times I would say that capex has in such sharp jumps year after year. That's one very good thing, because while globally when we had this pandemic, a lot of economies came out with big stimuluses, and most of these stimuluses were demand side in nature. And the flip side we are seeing around the world in terms of high inflation. But now this government has been focusing on the reverse side, on the supply side, on the thing that we build more capacity, more roads, and that will crowd in overall investment, and that will create jobs, and that will create demand. So the different way to steer the economy out of the pandemic. I think it's a good way. Arguably, India is still deficit in terms of investment, in terms of infrastructure, and these things are a little risky. And globally, and we have seen a big example in China. It's the government which has to drive all these investment where returns are risky and doesn't come quickly. And I think it's a very, very good attempt in that direction. Having said that, we all have a lot of expectations from budget, but in economics, we have this fundamental equation that expenditure is equal to either your tax revenues or your borrowing. So there are no free lunches. So either you tax people more or you borrow more. That will result in increasing of interest rates, and that will have an impact on other segment of the economy. It can result in more inflation. So there's a tightrope walk which governments have to do, and within the constraint, I think they have done a pretty decent job. The numbers are very credible. The tax numbers are very credible. The focus on capex I just mentioned is quite good. And they have again tried to consolidate from a very high level of fiscal deficit from 6.9% last year. Now they are targeting 6.4%. Market expectation was between 6.6 to 6.4, and that I think it's a pretty okay number given where we are in the economy. Some people are complaining that there have been lesser outlays in terms of revenue expenditure, social sector schemes like health and education, like health in particular, and also rural development. But the fact is that last 2 years, because of COVID, government had to substantially increase its allocation for vaccination, for free grains, for increased Narega allocation. Now, because hopefully, if the worst of pandemic is behind us, we are normalizing to the pre-COVID trend in terms of that breakup of government expenditure. And we should always remember that fundamental equation that expenditure has to be matching with either the taxes or the borrowing. And both of them are not a very good option. So within the constraint, I think it's a pretty decent budget.
Well, we've seen buoyancy in tax collection, so hopefully that goes in some way in creating some fiscal space for the government in order to bring some relief to the ordinary taxpayer who didn't get much during this budget. Even though always any budget there is an expectation that something could be given, but we'll see how things progress.
But that option was actually there for the government. I would say that option was there for the government, to bring some tax relief on the income tax side. But I think what they are doing is that they are creating some buffer for the higher crude prices. So they've already cut excise duty somewhat last November, and it is quite possible that if crude prices remain at these levels, then the current pump prices are not reflecting the crude prices plus the taxes. So either the pump prices have to go up or the taxes have to be cut further. So I think they are creating those buffers over there. But everybody wants somewhat lower taxes.
Gautam, can I add something?
It's a tightrope walk. Sure, go ahead, Amit.
Yeah, I think when you have a stronger mandate in the government, it always means that first 4 years are for the industry and the last year is for the farmer. and you also have elections next year. So you will have that everything which you wanted, a full masala movie coming in the next budget. All populist measures, all Narega, all subsidy, all farm waivers, everything will come in the next budget. When you have a weak mandate, you have 4 years for the farmer and 1 year for the industry. So what you didn't get this time, I think picture abhi baki hai. Everything for the populist vote will come in the next budget, Gautam, and that's why we didn't have any announcement this year.
Fair point. They held back all the masala and waited for the election year to come in so that they can then put in all the proposals and all the headlines will come out of it being a dream budget as it usually does. Well, fair point taken. That's our assessment of budget 2022. Let's move on to specifics now, especially related to the investment community. Dhirena, I'll come to you. According to you, what has been the most important takeaway for the investor community from the highs and lows of 2021? Since we saw such a record breaking rally, it gives you a pause for thought, especially as to how we started Jan 2022. So your thoughts on the reflection of 2021 and the resolution for 2022?
No, one is that, a grim reminder that it is futile to actually guess it because nobody gets it right on a broader basis. Then comes, of course, 2020 was a grim reminder once again that, focus on the basics, that is paramount. And, focus on yourself, having a great foundation, equity for the long term, having a good emergency fund, having your insurance, in fact, 2020 has been the biggest, education for insurance, or, if people have to really experience or feel the need for that. So, back to basics, 2021 is something that, one should take that diversify. If you have your basics in place, you will benefit. It is very difficult to plan it tactically year on year basis. You have to really take a long-term view.
All right. Considering the volatility, a period of sense and sensibility is valid for investors to approach their financial goals. Harit, I'll move on to you. What are the investment trends and products that, according to you, created a stir in 2021 and that you see expect to gain traction among the investor community in 2022? We've seen the rise of passives. Anything else that you would like to add in terms of key investment trends to watch out for in 2022?
So, Gautam, I think there are five key trends from an investor perspective that I'd like to touch upon. First and foremost is obviously the immense increase in retail participation in the equity markets. The amount of increase we've seen in demat accounts, active SIPs that are there. I still remember there was a time when, a new fund offer from a big fund house used to get about 8,000, 10,000 crores once in 2 years. And now we've got a case where every month we've got a SIP book of about 10,000 odd crores going in, which is predominantly equity in nature. So there's a very welcome, widespread retail participation in the equity markets. Second, what I've also observed is that there is a recognition and acceptance of the fact that you need professional guidance and support. So more people are willing to sign up for fee-based advisory, and that then kind of links up to goal-based investing rather than just investing per se. So something what Mr. Kumar just alluded to, that get your basics right, get your financial plan in place. That's when I seeing a wider acceptance of that fact. The other thing is, and that's again something that 2020 and 2021 taught us is, as a financial planner, when somebody used to talk about a contingency fund, it was earlier considered a theoretical concept that, okay, your planner is saying so you'll put around 2 or 3 months worth of expenses. But now I think a lot of people are accepting that that's a reality, and contingency funds are not 2 or 3 months expenses. It's more like a year, 18 months kind of expenses. So that's there. Then there is the fact that investors are now more aware. They are willing to look at a much wider bouquet of products. So we've seen a huge demand in international or global funds coming in. investors are looking at small case investing. People are wanting to go into commodities, so you've got ETFs on commodities, etc., coming up. So there is a much wider appetite for looking at a wide variety of products, but also then doing a diversification and risk mitigation there. A slightly concerning thing, which again Mr. Kumar alluded to earlier, was this whole blind rush for cryptocurrencies without really understanding what you're getting into. But I think that the lure of easy money is hard to resist at times, but then that needs to be tempered out. And finally, I think there is also a perceptible increase in DIY investing, wherein people are willing to put in effort to educate themselves and then go in for a lot of these passive funds which are available. So I think those would be the five key areas which I have seen over the last couple of years. Again, as the markets pan out, uh, you know, uh, it all looks rosy when the Sensex is shooting up 1,000 points every day. But when we reach a realistic bear run, sorry, and if that ends up being a elongated bear run, that is where then I think there'll be a more tempering of approach, and I think that would then complete the cycle of education and make sure people have a balanced approach. Again, I think Mr. Kumar used a very good term, get your basics right. If your basics are in place, your plan is in place, and you stick with your goal based allocations, you are in a better place.
All right. Thanks a lot for that overview of key trends, Harit. But it's also interesting to see the rise of the Indian retail investor, because I was reading somewhere about an analysis that as foreign portfolio investors took their money outs last year, the dip was acute. But when they did the same thing this year, the dip was not as acute because retail investors in India came in and created a sort of a mitigating effect. So the rise of the retail investor in India is also a key trend to watch out for. But speaking of the other side of this equation, Amit, what are the trends in the investment world that you think should be left behind?
I think people are used to ordering groceries in 10 minutes now, Gautam. And that should not be the case in investments, because last year people are used to making 10% in a week. So that is going to be a big surprise for all the new investors which have come into the market and who have not seen cycles over bull and bear markets. Another thing is 60,000 is a number. We all remember that Kapil Dev made the famous 175 in one innings. And that time people thought that, okay, this is a lifetime achievement, nobody can break that. But we all know that Sachin made 200, 186, Ganguly made 183, Sehwag made 219, and Rohit Sharma actually made 264 in a innings. So no high is a lifetime high. And what we need to understand is if I'm going to invest for the next 5, 10, 20 years, should a 10% correction, 15% correction actually bother me? So the 10-minute grocery, I call it as something which will weigh on people's mind today because they want quick returns. When you go in a hotel, Gautam, the dosa on my friend's plate always appears crispier to me. And I try to say, कि boss, मेरा डोसा ऐसा क्यों नहीं है? And I try to imitate somebody else on investments. I don't think so. One needs to do that. And I always try to put this into clients' mind that there is no correspondence course in swimming, Gautam. You need to actually go through the lake. You should dip, test the water. You should try doing some exercises and then probably swim. So last year was, I would say, beginner's luck for anybody who has entered the stock market. But this luck can soon wear out. I'll just finish it with one live example. Isaac Newton, Gautam, had invested in a company called South Sea. And Isaac Newton made a bumper profit, 100%. And he made 7,000 points way back. That time he had written, Gautam, that I can probably assess the movements of heavenly bodies, but I cannot assess the madness of people. Okay, so he went out with a 7,000 pound profit, and the same Isaac Newton entered into the same stock at a higher level and he lost 20,000 points, which is worth $3 million today. So, the behavioral economics, behavioral finance, and the temperament is utmost important when it comes to investments. Do not take investments as probably buying anything off the shelf. Even if you are buying a fridge, you go to 10 houses and see where the chiller is, how big is the freezer compartment, how big is the vegetable compartment. But when investing in stocks or mutual funds, you don't really look at what the company is doing. You just say, okay, this is something what somebody has told and I'll buy. Avoid that. I think you need to have a safety net, assess your risk, and accordingly plan your investments.
Well, wise words indeed, and nobody can predict the gyrations of the market, and the gravity is entirely unpredictable. Just when you think you've reached the top, you will see more rises coming in, and just when you think you've reached the bottom, you might see more dips coming in. So, as they always say, don't try and time the market. Have your goals in mind, plan your investments accordingly, and of course, as Amit has mentioned, don't blindly follow peer pressure. And it's a very interesting statement that you made, that you never have a correspondence course in swimming. You need to be part of the market to understand how things work, so that you at the end of the day can have some control over your financial management and make sure that it reaches its destination accordingly. Thank you for sharing your thoughts with us on that, Amit. Bhupesh, coming to you, where do you see things stand for the markets, especially for equity and fixed income in 2022? Where are we headed, and what are some cues to watch out for, in your opinion, for investors?
Yeah. Okay. I think there are two, I would say, key variables which will be determining the outcome both for the fixed income markets and for the equity market. One is the old one, pretty old one. We have forgotten it for the last 7-8 years, at least in the global markets, and that is inflation. What we are seeing is, last 2 years we had this mother of all stimuluses from both the central bankers and the fiscal authorities, and that came in the wake of this COVID pandemic, and all these bottlenecks which were there in the COVID pandemic, and that had resulted in big flare up in inflation across the world, also in markets in economies where people were never used to inflation. Policymakers had forgotten that there is something called inflation. So in US, the numbers are coming at 4-decade high. We are getting upside surprises also in United Kingdom. Also in Europe, we are getting very high inflation. Commodity prices are ballooning booming, across the board. Crude prices yesterday were 90 plus. So that inflation is a big scare, and that remains the key variable to look into. That will determine the course of both the equity and the bond market. And second one, I would say, is COVID. We've had waves after waves, and while the impact of every subsequent wave has been declining, but it impacts economies in two ways. One is in terms of the actual demand destruction, when people lose jobs and can't go out of their home, and second is in terms of dislocation of the supply chain. So over the last 2 decades, global supply chains have been extraordinarily diverse, uh, spread out against across the world. Something getting made in Korea, some in Taiwan, some in China, some in Vietnam, and then that travels across the value chain through ships and all. And COVID was the perfect nightmare for such a scenario. And so while the direct demand side impact of COVID has come down, as you can see around that, people are getting more comfortable in dealing with COVID. The virulence of this latest virus was much lesser. A lot of us are globally have got vaccinated, either through the actual infection or through the actual vaccination. So while the demand side impact of COVID is limited, the supply side disruption that it can cause is still there. So that is another variable which we should track. Our base case assumption would be that, given that every subsequent wave is turning out to be less virulent, and Omicron was especially non-virulent. So while the impact of COVID may keep on declining, inflation remains the key worry for the markets. Last 2 years, a lot of people were quite astonished that how come in such a massive crisis, global health crisis, how did markets flare up so much? And the simple answer, which most of us now know, has been that of extraordinary stimulus which had gone into the market, both fiscal and monetary. Now with inflation coming back with the vengeance, central bankers are turning, dialing back their extraordinary accommodation. So while most of the last 2 years, every subsequent statement which used to come from Fed and the Fed speakers used to be like, competing with each other, ki how dovish they can be. Now it's almost, the 180-degree turn that we are seeing. Every subsequent data point, every subsequent communication from Fed, that is coming, incrementally more hawkish. And that's not only in Fed, across the board, across the world, you look into global central bankers, everyone is dialing back their extraordinary stimulus. So that is going to be one very key determinant, that how fast they dial back the stimulus and what impact it has on the markets. Because in equity markets, one key reason why probably this market has gone up so much, one is the quote unquote the liquidity which the central bankers supplying the market by doing quantitative easing. The second is when they reduce the discount rate, everything gets discounted. Every future profit gets discounted by a lower rate, and that reduces the expectation of returns in the stock market. So this remains a very key variable, and I think that for the last post global financial crisis, the markets have got used to this Fed put, as they call it, that bad data is actually good data because Fed will come in. Now that Fed put is very much in question, or at the very least, you can say that the strike price of the put is much lower. So in 5% correction, 10% correction, don't be sure that Fed will come to save the market. They have been under a lot of criticism. Now, inflation has become a political issue in US because getting 5% inflation, then 6%, then 7% inflation persisting for an economy which is used to 2% or less than 2% inflation. So this political pressure has built up a lot in Fed, that they are looking after the rich people, the markets, and not, the Wall Street and not the Main Street. So all these combined.
That could happen here, right, Bhupesh? That could happen here as well, because that could happen here as well, right? Because the fiscal firepower is almost close to exhaustion, considering the period of extensive easy money policies that we have had. And as India itself faces an election year, the question is, with limited fiscal firepower and inflation still as a major headwind, what does the government do? So that's a question which is still left to be addressed. Are you optimistic about the prospect?
So generally, so equity markets returns are determined by two factors. One is what is the growth, and second is what is all the sub factors, the policy, the interest rate, the discount rates. I think from a growth point of view, we are in the cusp of a multi-year, hopefully in a cusp of a multi-year bullish run in terms of economic growth. So last 5, 6, 7 years, we have seen a lot of growth costs in terms of structural reforms, bringing down inflation, GST, IBC, bankruptcy code. Then we had this big COVID shock. Demonetization. Hopefully, I think we won't be getting. We can only hope that no other extraneous shock should come to the economy now. If that hope is not belied, then I think, given that balance sheets are very clean, policy rates are still very low, real rates are at significantly below zero, and government is focused on building capacities. Plus, after 7, 8 years, if you haven't invested, the cyclical sector also starts turning up. So from a growth point of view, we remain quite bullish that India can grow at a pretty decent rate over the next 5, 6, 7 years, and that should provide a lot of support to the equity markets. The problem is, that equity market is a combination of what is happening in the growth front and what is happening on the policy front, and there the global backdrop in particular isn't that benign. So I think the best case would be the best judgment you can make right now is that it should keep trending up. But it won't be as smooth a ride as you had seen in the last 2 years, because with Fed tightening its monetary policy, Fed is like a central bank to the entire markets, the whole global market. If Fed start tightening the policy, it does create a lot of volatility that you can't avoid. For the fixed income market, I think rates have already gone up quite a lot, and fixed income has to be a part of your overall portfolio, especially it's counter-cyclical typically to the equity markets. And at points, at 4% point, at 4 or 5 year duration point, there's still a lot of juice still there in the fixed income market. So you have to choose your point accordingly, where you are positioned in the fixed income market. There are a lot of places in fixed income market where you can still make decent returns. While generally one would believe that in a rising interest rate scenario, you should stay away from fixed income market, but I won't say that, because fixed income has to be a part of your portfolio, and given the fact that yield curves are very steep, if you're rightly positioned in the fixed income market, you can still get pretty decent returns, especially if
All
you're
right,
aware for the risk.
that is
Gautam,
optimistic considering where bond yields are. But I'll come to you on that later, Bhupesh. Amit, you had something to say.
yeah, I think what we have to understand is whenever you have hyperinflation or inflation coming into your economy, the only asset class which loves inflation is gold. And as financial planners, what I think the one mistake what everybody makes is we say that gold should be 5-10% of the portfolio. Now, when you have, I think Gautam, in our lifetime of studies, I think hyperinflation was a passing remark in our economy textbook because we have never seen hyperinflation after 1960s anywhere. So when you're going to see such kind of inflation numbers, I think you should up your gold exposure as well. You might see a 10-15% downside on gold, but whenever you see a hyperinflation number, you will always see one asset class which loves inflation, and that is gold. So
Hmm.
do away with your myths of putting gold as 5% or 10%. Your debt portfolio can move into gold even today because if inflation is coming, your interest rates are on the rise and you will keep losing money on your medium term and long term bonds. So you should move actually your debt portfolio into gold and sit for a period of
Hmm.
18 to 24 months. By that time, you will figure out what is coming in the budget next year, what are the election results. You will get an opportunity there as well. And remember, as uh, what you can say, a coconut tree which grows too much, a small wind can actually uproot that. So if
Hmm.
that coconut tree is of inflation or if that coconut tree is of interest rates, a small wind can actually make that very difficult for everyone. And inflation is something which can prick all asset classes, be it real estate,
Hmm.
be it equities, be it debt. And the only asset class which loves inflation, unfortunately, is gold. But since the notional returns in gold are poor, because people generally buy gold and don't sell, so view gold as an investment asset class rather than as a wearing asset class. And if you
Hmm.
put money in gold, you should clearly have an exit strategy in place. That will be my two comments.
All right. Words of advice from Amit. Let's extend that advisory train and let me bring in Dhiren. Dhiren, what advice would you give to those who have had to empty their financial reservoirs and start their financial journey afresh, owing to, say, exigencies triggered by the pandemic? Because this is also in response to what people have faced during this pandemic, whereby what they had planned, things changed substantially. They had to liquidate a significant part. They might have to liquidate a significant part of their portfolio if they didn't have, say, the right kind of emergency funds in play. So your words of advice to financial investors now as they restart their financial journey.
Replenish it, and I think, the immediate steps are actually non-financial. If your income stream got disrupted, go and restore it, whatever it takes, because your savings and investment is on a standstill till your income is restored. A lot of people would have also, there are two other scenarios. I come across a lot of people who came on the brink of that disruption. So maybe, this is actually a time where people should work towards. It is not a crisis right now, so they should work towards, broadening their skill or whatever, so that they have a marketable skill. And the world has changed, the work environment has changed. So how will you still be relevant? That is something which people should worry about. The other is that, get back to basics. Foundations matter. All your finest of ideas will actually go waste, even if you are confident of the great opportunity which market was presenting. You will not be able to think in the right, you will not be in the right frame of mind to capitalize on that if you don't have your foundations in place, which is having enough for, you don't have to worry about the tomorrow. And time is on your side. So work towards that. I think these are things which I would suggest.
All right. And of
And
course, the
some of the
usual
things,
questions.
sorry, I would just like to add, at the cost of sounding like a stuck record, that when I'm referring to worry about the basics, which is equity for the long run, fixed income for the short run or immediate term. Have an allocation to fixed income even in your long-term portfolio for rebalancing. Then diversify. Don't get very tactical. And if you have this thought process in place, I think even missing out on some of the tactical things won't matter.
I think that's also another issue that folks approach it sometimes tactically. They're tempted, right? Because the usual question, let's say between SIP and lump sum, when they see markets correct substantially, they wonder, should I do SIP while, and suddenly I should put in also a lump sum amount when the markets correct like this. Any words of advice you would have to investors when they face such questions as to what to do in the case of a significant market correction?
Yeah, I think they should just they should actually read newspapers, they should watch TV, they should listen to it, but not act. Because most of the time we are prompted by those things, by suggestion, advice, or inputs that may not be relevant. Because you have to guess the future. That is a broad feeling. But most important guesses about future is about yourself. That is the only thing which you can do with precision. Rest of the things, what last 2-3 years have demonstrated, that you can't get it right. Nobody knows. So be very have the humility, be sure of that. And if you have those basic variables in place, nothing else matters.
All right, have your basics in place. And when we speak of basics, I think financial literacy also needs to be in focus. And since we're speaking on financial literacy, I'll bring in Harit to explain that viewpoint. The financial inclusivity movement, Harit, that has gained momentum in the pandemic with a record number of people trying their hands at equity investments. However, with what financial literacy levels being abysmal, there's still ample room for investors to be misled and manipulated. So in your opinion, how can players in the financial services sector bridge that gap in terms of financial literacy so that people can take sensible financial decisions, knowing fully well what it entails and how it ties back to their financial goals in terms of impact?
Yeah, Gautam. In fact, that's a topic very close to my heart. So thanks for bringing it in. Like you rightly said, education is very important because what happens is you see the kind of environment that is there. You read what's happening in the papers. You hear your friends, relatives talk, and you invest without really understanding what are you getting into. And then if you hit a bear market and you lose your money, typically people tend to withdraw and then not trust that instrument ever again. So education is critical. It's also very critical because if you really want to everybody's got limited source of income. Now if you want to increase your wealth to fulfill all your goals, you definitely need to invest. So that literacy part is very critical. I think there are three key areas I would like to touch upon. The first two would be in terms of the population that we are addressing. There's one part which is being totally unaware of the complete gamut of investment products available. So there you need to literally start educating from the basics ground up. What are the various instruments? What are the categories, risk, so and so forth. The other set of population which I feel also needs to have a focus on this education is people who have been investing but who've got partial knowledge. Just to give you an example, I've seen a lot of people equate debt with an FD. So in their mindset, if you are investing in a debt fund, it's as safe as investing in a bank FD, right? So in terms of what are the risks associated with debt products, what kind of cycles can debt go through, they're not aware of. They'll just pick up the latest newspaper, see which fund gave the best returns in the last 3 years and blindly invest, not realizing that if it's a duration product and you are at the end of one cycle, the other cycle is actually going to take you negative or flat. So that education part is critical. Now if I was to go back, let's say 10 or 20 years ago, a huge challenge was infrastructure, logistics. If you're trying to impart education, how do you reach out to the masses? Those days we used to do broadly classroom based trainings. Now there's a limit to how many people you can get into a classroom and how many people can you reach in the physical world. A great thing that has happened over the past few years is one, we've got good internet connectivity and reach across the whole country today. Two, people are more comfortable uh, being willing to take the inputs from a online medium. So I think that is something we really need to look at capitalizing. Initiatives like the one we are having today, where through the digital medium we can really want to kind of reach out to a huge set of people. This coupled with good quality content, if the players in the industry can all come together and we can create content which is easy to understand, devoid of jargon, gets the basics through very simply, and use the art of storytelling, because India is a land of stories. People understand concepts through stories very well. So if we kind of put all of that together into our digital content and then add it up with uh, initiatives like this, where there's also a person, a face to talk to, I think that can combined be a very, very powerful tool of taking financial literacy to the masses. The other thing I would very quickly want to touch is that, when we talk of financial literacy, we mostly focus on adults. Our focus is basically on investors, so to say. I think a key focus should also be on children. You know, uh, Typically, if you see, especially when we were growing up, when money matters were being discussed, kids used to be, shooed away. It's just for parents to talk. I think that mindset needs to change. We, as it is, teach compound interest in school. So if you're teaching compound interest, why not teach the power of compounding as well? If we bring that financial literacy right from, when kids are in school, the basics foundations would be built much earlier, and that then also gives you a good framework to look at money in the right perspective. And I think that is going to be a huge outcome for the whole country per se.
Absolutely. And that's an important point. Make financial management a regular part of our lives. And if you start it with schooling and build it within the curriculum, it makes sense that, kids will grow up learning about financial management, learning how to do their taxes and not worrying about, what does this all mean? What do I need to do? Fair point. Point taken. Another aspect, and I'll bring Amit to this. Amit, in terms of models, what are your view of the growing popularity of, say, ESG investing in India? Do you think, say, 2022 will see more takers for ESG funds, since as an idea, it makes sense to a lot of people that it's related to sustainability. So your thoughts on this?
Uh, my take is that mostly European countries generally have a lot of interest in ESG, and those foreign investors are actually looking at ESG companies. Definitely, you had China, who had a problem with pollution, and you had a lot of chemical companies which moved out of China. Gautam, interesting point to note is that we say that we'll drive EV cars, and we all are betting on startups in EV, the connector companies, the wires, whatever we want to do with EV. Nobody is actually looking at how much pollution is caused by creating that lead battery or the battery what we have in the EV today. So ESG investing is good, but I don't think so that you will have a pure ESG play. For example, to fire the smelter, you will require coal to fire it up. You can't really say that I am 100% ESG compliant, right? So ESG is a theme where people want to invest in. I might put it as less polluting, less damaging companies to the climate. But as a pure play, I don't think so that is going to happen. We embraced specialty chemicals and API companies in India, which were banned in China 2 years ago because of pollution. And we have given a lot of valuation to these companies in the Indian stock market. So, what is more critical is how self-disciplined we will be in controlling the pollution there. And it's not only on pollution, on social and on government things. 6 crore people having PAN cards, 130 crore population. I think we need to focus on that. So, ESG as a theme will stay. Whether you will make money or not, time will tell. But suppose a cigarette making company gives out 3,000 crores to build a cancer hospital. Will it be a ESG company? I don't know. because they are doing a social impact. So ESG as a theme is there, but I don't know whether we will be able to make money. I think when you want to make money, sorry to say this, but no success without a crime, Gautam. And that's how you make money in the stock market. I might sound rude here, but that's the truth about stock markets.
It's the bitter truth, but it needs, any medicine is bitter, but it has a curative effect. So we need that honest and frank conversations with our experts so that investors get to know what is real and what is not. And as we look to wrap up the conversation, before we do that, Bhupesh, we were speaking about, the bond markets, looking at bond deals, I think what 6.88% the last time I saw it. Your take on bond deals, where are things headed here from now?
Yeah, so I mean, bond markets are buffeted by two sources of shocks recently over the last 2 months. One is the Fed making this big U-turn in terms of their policy, and second is the very big supply of government papers. So budget, so 2-3 years ago we used to have a budget government gross borrowing of around 6 lakh crore rupees. From the last 2 years, that number had been around close to 12 lakh crore rupees. That is double the previous pre-COVID trend. And this year, the announcement has been around 15 lakh crore rupees. So that's a 2.5x the amount of borrowing which government used to do before COVID. So that's a lot of big supply shock into the market, and markets are dealing just still wondering how to deal with such a big supply of papers. But on the other hand, the RBI monetary policy still remains very, very accommodative. And if you see what happened yesterday in terms of cancellation of bond auction, it appears that RBI still stands committed to orderly evolution of yield curve, which they have been saying for quite some time, and they have been following through that. So that's one good thing. So it's a combination of factors, too many moving parts. Net, there are two things which are clearly worry for the market. One is the Fed pivot, and second is the big supply of papers. But having said that, currently the overnight rates are at around 4%, just a little below 4%. If you look into where the BRRRs are cutting off, that's I mean, yesterday, as you rightly mentioned, the 10-year paper was at 6.8, closer to 6.9. So that's a 290 basis point of spread that we are getting between repo and the 10-year paper. That's one of the highest spread that you would get in Indian markets in a very long time. The average spread used to be around 70, 80 basis point, closer to 80 basis point, I would say. So what I mean to say is that a lot of, all these factors are already in the price of the bond yield. Markets are like, discounting machine, future discounting machine. They quickly discount what is going to happen. And the moment markets started fearing that we can see higher fiscal deficit and higher supply of paper, they started trending up immediately. And while this borrowing will start in FY23, yields have already reacted to that. So you get incremental shock into the market, incremental shock in terms of returns, only when the actual turn of event turns out to be adverse to what it is already in the price. So what I mean to say is that, while on the longer end of the yield curve, there is still some possibility that some further adjustment can take place over the next 1-2 months as markets try to fathom out what the RBI response would be to this very high borrowing. But given the fact that the yield curve is so steep, a lot of negative units is still already in the price. And if you are in the intermediate, I mean, up to 4-5 year point in terms of maturity, 3-4 year in terms of duration, I think the likely further rise in bond yield will be more than compensated by the high carry that you are getting if you are moving up the yield curve. So there's a sweet spot in terms of yield curve where you can be positioned, which can give you a pretty decent returns in the overall bag mix of various asset classes that you can have.
Gautam, 5 years ago, 1 year FD and 5 year FD were at the same rates on fixed deposits. That time it was a good time to lock in for 5 year FDs. Today, 1 year and 5 year FDs are at the same rate. It's good to lock in on 1 year FD today.
1 year
That
FD.
my short and sweet.
It makes me wonder, what the folks are thinking when we look at the long-term picture and we see what the data is currently showing.
Yeah.
But of course, that could be another panel discussion on its own. As we are looking to wrap up the conversation, let me get a summary thought from each one of you for around 30 seconds or so. Resolutions for investors in 2022. Your thoughts. Dhiren, we'll start with you and then we'll go around the table.
If you have a plan, stick to it and don't get distracted. If you don't have one, write it right away and start following it.
All right, stick to your plan. That's the word coming in from Dhiren. Harith, your thoughts on resolutions for 2022 for investors?
So I think clearly the honeymoon doesn't last forever. So, get your head down, educate yourself, have realistic expectations, build a contingency plan for yourself, have a goal-based plan, and then just stick with the plan, go through with your plan with diligence. And I think as long as your expectations are realistic, you're gonna make money.
All right, Amit, your thoughts on the resolutions for 2022?
So apart from the Mediclaim and the term plan, what every panelist is saying, I think one important thing is sell to optimist and buy from pessimist, Gautam. That's the key success. So you need to
Fair
look at
point.
that. Yeah.
Fair point. Wise words from Amit. And finally, to you, Bhupesh, your thoughts on what investors should resolve for in 2022.
Yeah, I mean, well, there will be volatility in the market. We should be aware of the fact that India is a very good, a very long-term structured story. And if you are positioned rightly for that, I think you will do pretty good over the next 20 years.
All right. On that note, gentlemen, it's time to wrap up our discussions on reflections and resolutions for 2022 and the lessons that we stand to learn as to where things are for the markets and, of course, for investors. I'd like to thank all of you for joining us and providing us with your perspectives. I hope our investors find ample guidance in your words that can pave the way for them to effectively manage their finance in 2022. And as Bhupesh said, the India growth story is long term. And as the rest of the panelists have said, you need to stick to a plan and make sure it's connected to your financial goals and have the discipline. Don't just follow peer pressure. Create a plan for yourself which makes sense, which helps you achieve your goals. And I'm sure you will reach them. Thank you so much, gentlemen. Great speaking with all of you on this topic. Meanwhile, it's time now to move on to the next item on our agenda. And that is to take a look at how investment in a disciplined manner towards attaining life goals can help an investor win with an SIP. Take a look.
किसी की छोटी सी एक चाहत, बड़ी किसी की प्यास, बूंद बूंद भरते हैं सागर, है हमको विश्वास।
घर घर है लाखों सपने, हर सपने की एक जिंदगी, कोई घर फिर क्यों छूटे, हर घर जब हो SIP। तेरी मेरी बने हमारी, हो तैयारी जीत की पूरी, together we can win with SIP। हटसो जर लहानगीचा, किंवा सो आजीची आशा, घरोघरी आता असेल SIP, कल्ला सगळ्यांचा आपला आपला।
తండ్రి బిడ్డకు ప్రాణం పోసే, తల్లి ఆమెను తీర్చిదిద్దే, వారిద్దరి కళ్ళకు ఆమె రూపునిచ్చే, వారికి SIP తోడయ్యే। तेरी मेरी बने हमारी, हो तैयारी जीत की पूरी, together we can win with SIP। वाइफ करे फॉरन माफले के, पति चलावे मनपसंद गाड़ी,
ನಮ್ಮದೊಂದು SIPಯಲ್ಲಿ ವಿನಿಯೋಜಿಸಿ ಎಂದು तेरी मेरी बने हमारी हो तैयारी जीत की पूरी together we can win with SIP.
അവരുടെ സ്വപ്നങ്ങൾ ഉറങ്ങിപ്പോയിരുന്നു സ്വപ്നങ്ങൾ അവരുടെ ഉള്ളിലൊതുക്കിയ സമയമായി അത് ഉണർത്താനായി SIPയുടെ ലക്ഷ്യം സഫലമാക്കാനായി
যেদিন এই বাড়িতে সে আসলো একটি প্রতিকাশ করলো অল্প অল্প করে জমা করবে বাড়ির ভাগ্যগুলো পাল্টে দেবে ভাগ্যের চাবি বানাতে পারে প্রত্যেক বাড়ি যদি SIP করে
तेरी मेरी बने हमारी हो तैयारी जीत की पूरी together we can win with SIP.
An investor education and awareness initiative by Aditya Birla Sun Life Mutual Fund.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।
All right, let's move on to the next session, which is a fireside chat with Mr. Patil, Chief Investment Officer of Aditya Birla Sun Life Mutual Fund. That is coming up right now. All right, time for the fireside chat. Now, the process of laying the financial pathway for the year is incomplete without a deep dive into the annual budget. Now, Union Finance Minister Nirmala Sitharaman has recently unveiled Budget 2022. And as far as personal finances are concerned, this year's budget did not include any major announcements pertaining to taxes. Up next, as we mentioned, is a fireside chat with Mahesh Patil, Chief Investment Officer of Aditya Birla Sun Life Mutual Fund, on the takeaways for retail investors from the Union Budget 2022. Mr. Patil, welcome to Nivesh Mahakumbh 2022.
Yeah, hi Gautam.
Hi, Mahesh. Well, as opposed to expectations, the budget did not include a hike in standard deductions for salaried individuals or improvements in deductions for investments. So I want to get your first thoughts on that.
Yeah, so I think this time around for the finance minister, it was a tough task in terms of trying to balance, right, between the fiscal deficit and how to stimulate the economy, right? Because post-COVID, I mean, we had now 1.5 years, almost 2 years post-COVID. And initial part, I think we've seen the consumption getting impacted. And we saw in the last budget, there were incentives given, right, in terms of tax deductions to stimulate consumption and increase the income levels. I think this time around, I think considering the fact that the fiscal deficit was also a challenge and there was not much avenues, okay, where they could really spend that, I think the finance minister chose to really stimulate investments. And that's an area where bulk of the spendings have gone. In the view that if you do it now, then over the next 2 to 3 years, you will see the benefit of that in terms of the economic growth. And overall investments have kind of collapsed over the last 4 or 5 years. And it was important to continue what they did in the last budget in terms of stimulating domestic manufacturing and going in on that path. So while it was a disappointment for retail investors and individuals in terms of reduction in the tax rate of tax slab, but I think you can't actually have a reduction in tax slabs every year, right? And more so, I think the budget is going to be more about tax changes, right? More in terms of policy direction, I think is what we should expect. So, yeah, so I think it is stimulating growth, more from longer term growth, I guess. Yeah, I think going forward next year, I think as we move towards elections, general elections, right? Probably it will be trying to probably give more money at the hands of the consumers and stimulate consumption is what my guess would be.
Stimulate consumption. Let's see if that works. Now, one of the most talked about things of the budget was the introduction of the digital rupee and a tax of 30% on the proceeds from sale of cryptocurrencies and other digital assets. So, Mahesh, how will this impact the cryptocurrency investment gamut in India, in your opinion?
So I think for the first time, the in the budget, the finance minister gave a roadmap that they will have the central bank digital currency, okay, CBDC as they call it, which is not exactly competing with the cryptocurrencies because that is a digital currency which will replace your existing physical cash to some extent, and unlike the cryptocurrency, which is very volatile and speculative, and the prices keep on changing on a daily basis and pretty violently. The digital currency, which will be more substitute of the domestic cash currency, and it will be much more stable. So that is more to do with ease of transactions, trying to because there's a lot of cost which is incurred in terms of printing the physical currency, the notes and the coins, and also from a security purpose, digital currency is probably the future, and that's where the government has taken the initial steps. On the digital assets, the 30% tax is probably to attack the cryptocurrency market because we've seen that government is not so happy with investors speculating in the cryptocurrency market, and we've seen that in the last couple of years, a lot of retail investors have participated in that, made some money, probably seen some losses also, but it's a very highly and speculative market, and we've seen prices go up probably 100%, correction of around 50% or so. So, and again, it was need to really tax and regulate that in line with the other because it's cryptocurrency is more people view it as an investment alternative, right? More speculative, whereas the digital currency is more of a ease of doing transaction, right? That's what it will be. So I don't think people will really get impact, and the tax will have an impact definitely because a 30% tax is probably indicating that government wants only serious investors, right, who understand that market to really get into it, understand the risk and the pitfalls of cryptocurrencies. So to that extent, it dampen, but I think as investors, speculators will continue to look at as long as there is volatility in that space.
All right. Surcharge on long-term capital gains tax that has been capped at 15%. Do you think it'll benefit individual investors?
Well, I don't think that's going to matter much because it's just an incremental change over there. I think a lot of investors, okay, when they look at investing, it's not so much the tax rate, and surcharge is just an incremental tax over and above that. So I doubt whether that will really matter much when investors are making their investment decisions. I think it will be more driven by the outlook, okay, on the asset class, okay, or on say in the equity markets, what kind of returns they will make, which will drive that decision. It's not really a meaningful cut, though it is good because all these cumulative taxes and surcharges were really adding up and taking up the tax rate much higher than the headline tax rate which was there. So in that sense, it's a welcome step, but I don't think it really changes the investor decision making.
All right, but based on the announcement in the union budget, the string of announcements which have come by, which demographic of retail investors, in your opinion, stands to benefit the most?
Well, there's nothing really as such because normally when there are certain tax breaks or certain category of investors, okay, you give those benefits, it stimulates savings and then into investments, right? And benefits in that sense. I don't see anything in the budget really category. They are not changing any kind of a tax structure for different categories of investors, and and the broader market, I think, growth, if it continues and becomes much more widespread, I think definitely. I think what we've seen is that in the last 2 years there has been a big increase in terms of the new investors or the penetration, okay, of retail investors has gone up, and that is a good sign in terms of deepening the financial markets and also the equity markets. And the way the budget, I think overall budget is still pro growth, I would say, and that will continue to drive economic growth for India to its potential growth rate of around 6.5%. So as that happens, what happens is that the growth becomes much more broad based. So it takes up every strata of the economy. While this pandemic has impacted a certain section of the economy, especially the non-salaried people and the self-employed and the small and medium enterprises, the government has tried to support some of those, right? The SME sector. But more importantly, the best way to do is to lift up the whole economy growth, right? Then it percolates down to everyone. And then a lot of these small retail investors also, as the income level goes up, as the job creation improves, they would have more savings and to be able to invest in that sense. So I don't see any direct this thing, but by and large, as economic growth comes back and there are enough drivers towards that, both domestic as well as export-led growth, I think it will benefit all class of investors.
All right. And amid this growth push for the economy, what are the sectors that investors should keep an eye out in the wake of Budget 2022? Your thoughts on that?
So I think, as you know, the India's economy is slightly lagging behind the global growth. Last year, we saw a good rebound in global growth, US growth. India was still struggling a bit because we had the second wave, which was much more intense, and there was not enough support. But I think slowly and steadily, I think we are seeing a revival. And I think the domestic economy-led sectors, right, will be the best sectors to do well over the next 2 to 3 years, is what our belief is. And within that, if you look at the largest sector, which is the banking sector and the financial services sector, which is always benefits when the GDP growth starts to improve. And we expect overall, as the capital investments start to pick up, the overall credit growth, especially the corporate credit growth, will slowly pick up, and that will benefit the banking sector. Also, the whole NPA cycle is behind us, right? I mean, we have seen large NPAs in the last 2 years back. We're coming out of the COVID crisis, and most of the bank balance sheets are well capitalized. So the banking and financial services sector clearly looks to be benefiting from the revival in the economy, the revival in the credit growth, and lowering of the NPAs. Apart from that, as I said, the capital goods sector, right, the industrials should benefit because of the increasing capex. The government in the budget, in the last budget, also there was a big focus on domestic manufacturing. We have seen the production incentive schemes being rolled out. I think those have been further strengthened in terms of number of areas, and some of the gray areas have been ironed out. So we see a slow and steady revival in the domestic private capital capex cycle. And the government is also doing its bit in terms of trying to put money into infrastructure and railways. So the industrials capital goods sector, I think, would see good order inflows in the coming years and should benefit out of that. The defense sector has also seen not a big allocation change, but more focus on domestic procurement, right, in the budget. And that domestic procurement ratio has been increased from 58% to 68%. And also more focus on domestic R&D and outsourcing that. So the companies related to the defense sector should see that better domestic sourcing too in terms of order inflows. So I think, so these are some of the sectors, okay, which one would see benefit, not only with the budget, but even from a macroeconomic uplift, okay, which we see going forward.
Any thoughts on healthcare sector, especially as we head into a post-pandemic world? Any thoughts on that, Mahesh?
So the healthcare sector, I think there are two parts to it. One is the pharmaceutical sector, and one is the healthcare, which is the hospitals and the diagnostic space. I think that's a sector which is likely to see with good growth post-pandemic. There's a large investments which still needs to be done on the healthcare side in hospitals, and I think while government can't do that, I think it's a private sector actually which needs to gear up to meet that demand. So that sector looks fairly strong in terms of long-term growth potential. Overall, the healthcare, I think, as health insurance and other areas gain more traction, you will see the pharmaceutical industry also benefit. I think it's been growing steadily in the last many decade at around 10% or so. But I think with greater focus on healthcare, on health insurance, I think this is a kind of a sector. Domestic pharma space is akin to a consumer sector, right, which is a steady secular growth. And I think the companies will continue to domestic pharma specifically, I would say, not so much export-oriented companies, will see a steady longer-term growth. Apart from the fact that there will be interims, this drug price control and price revisions, but that also impact is now getting utilized to a large extent.
All right, that's a quick primer on demystifying the budget for our viewers, and especially as the government tries to tackle supply side issues, here's hoping the working capital picture improves and they are able to address that. And of course, at the same time, while demand side issues are seen as limited, we hope that so those issues can be addressed as well. Meanwhile, let's take in some questions from the audience. Interestingly, we've been getting a few questions on our social media handles, and we'd love to take in a few of them before we move over to our next panel discussion. So, Mahesh, here's our first question from the audience. This one comes from Tarun Chauhan. He asks you, how do you perceive the current market? Will it continue to remain volatile? Your thoughts on that, Mahesh?
So we have seen a good bout of volatility in the last 1 month or so, right? I mean, last 1.5 years was a secular move in markets, again driven by a large amount of liquidity, low interest rates, and that scenario is changing now as we enter into this calendar year. We've seen global liquidity getting slowly withdrawn. US is doing tapering. Interest rate hikes are likely to be there globally. In US, they're talking about 3 to 4 rate hikes. In India, probably we'll see 2 rate hikes. So that easy money which was there, I think, slowly come down, and the secular rally, what we saw, one-way rally in the market in the last 1.5 years, is going to be much more volatile and bumpy this year, which is what the markets are normally, right, and which is nothing to worry about as such. There's also going to be some normalization of multiples which will happen. We have seen, because of the liquidity, when there is excess money, things become more expensive, right? And we saw the market P multiples had become expensive. Market was slightly running ahead of fundamentals. I think that will normalize a bit, though we are seeing good recovery of growth. So growth is, corporate earnings growth is going to be fairly strong. This year, we'll see around 30% growth in FY22. Next year, we're looking at around 15-17% kind of a growth. But the P multiples, which had gone up, will probably normalize a bit. And that is but natural when you see interest rates go up. And to that extent, you will see that there will be volatility. I think we haven't, even in a bull market, if you look at in the earlier bull markets, I mean, in the period 2003 to 2008, which was one of the large bull markets, we had almost 15 instances where the markets corrected by more than 10%, right? There were 3 instances where it corrected more than 20%. So I think corrections are going to be nature of the market, and we'll probably see more of those volatility in this fiscal year. Overall returns will also be more moderate this year because, as I said, there will be some normalization of P multiples which will be there. But I think nothing to worry about as such, because we are still on the macro fundamentals are still fairly strong. There is a good roadway of growth, okay, which we are seeing. We are seeing participation across many sectors. It's not like a 2 or 3 sectors which are doing well, which was the case around 2.5, 3 years back. It is being driven across sectors, and the markets will continue to move higher. I have no doubt about that. But you need to keep your return expectations slightly more moderate, expect volatility, and buy into those dips, right? Because that will make your entry cost much more better and increase the chances of making slightly better returns.
All right, Mahesh. Our next question comes from Monica Soin, and she asks, what are the advantages of a diversified equity fund? Your thoughts, Mahesh?
So we always say that when you are making your first investments into equity or in a mutual fund, it should be towards a diversified or a large cap. It can be a large cap diversified fund, or it can be a multi-cap, flexi-cap diversified fund. And the reason for that is that diversification across sectors at the stock level helps you to reduce the kind of volatility. It's a better way to participate the market move, right? Without too much of variance from the benchmark and slight outperformance vis-a-vis the benchmark. And a well-diversified portfolio reduces the risk of underperformance in a particular sector. We know that sector performance is cyclical, right? I mean, there's a sector rotation which keeps on happening. Sometimes it's the IT sector which does well. Sometimes it is the banking sector which will do well. A diversified fund is able to play across the sector, take measured bets, okay, and in a way give a much more better experience to investors vis-a-vis the broader market, right? Vis-a-vis the index with less amount of deviation. So I think, and especially in this current market environment, where we see now the market is becoming much more broad-based, right? It's not just the large caps, like unlike in 2018 and calendar year 19, it was a very narrow market, right? We have seen only a few stocks, large index weight stocks, do well. The broader market was actually down. And amongst the sectors also, it was only a few sectors, whether it was the consumer sector or the IT sector or the pharma sector, which is doing well. But now what we are seeing is the breadth of the market is improving. We are seeing large caps, mid caps, small caps, everything doing well, depending on their merits though, right? So a diversified fund will be able to play across that spectrum: market capitalization, large cap, mid cap, small cap, wherever there is value or wherever there is a good opportunity, and also multiple sectors, right? We have, as I said, we have seen domestic cyclicals do well. Even the IT sector is doing well. Consumers are also stable. So you can get all that into a diversified fund, and I think that should be your core of your portfolio.
All right. Our next question from the audience comes from Sunil Saini, and he asks, in current market conditions, what asset allocation will you suggest to investors? Your thoughts, Mahesh?
So I would say that, see, the asset allocation is very individual to a particular investor, right, or a particular individual, depending on his risk appetite as well as his time horizon, right? I mean, how young he is, how much time he has, right? These are two aspects. But once you have decided the asset allocation for a particular investor based on your all these input parameters, and for my advisor, I would say this is the time to stick to asset allocation. Probably, I would say if your target allocation was like 50% equity and 50% debt based on your risk profile, then I think one should continue to maintain that asset allocation. Probably, I would still advise that one can be a slightly overweight on equities, because while the near-term returns will be slightly muted, but I think over a 3-year time frame, I think equities can still offer you a better risk reward or better return, because interest rates are low, while interest rates will likely go up. The returns will be muted over there. And the outlook on equities longer term remains good. I think India is at a cusp where we'll see economic growth pick up. So given that, I would say against your target allocation, you can be slightly overweight equity. Don't be too aggressive. Within equity, don't try to take too much risk, because this year it will be more risk-adjusted return which will matter, right? It's not going to be a runaway market and everything will move up. You have to be much more discerning. Say a target asset allocation, what you have targeted, or slightly higher tilt towards equity, I think would be advisable. And this is, and in the market dip or in a market correction, I think one can increase that equity allocation, right? Because I mean, that will be we don't see this market really has peaked out. If it has got more legs, there are a lot of questions which come in whether we have peaked out. It's the peak of the market because the multiples are very expensive. But I say that while multiples are expensive, the earnings growth journey has just started, right? We are coming on from a down cycle in economic growth, and there is enough roadway in the next few years to really do well. So stick to your target allocation with a slightly higher bias, slightly higher bias towards equity. I think should do well.
All right. Next question from the audience comes from Falguni Patak. She asks, the Sensex has been falling down steadily for a few days now. And what are the primary reasons for that? And when do you see the situation improving? Your thoughts, Mahesh?
So the sense markets have been in a correction phase. You are right about that. And the reason for that is, and globally we have seen across the board markets have corrected. And it was as a result of the Fed policy stance, right, which has become more hawkish in the sense they are now talking about more aggressive rate cuts. And markets are fearing that if that happens, okay, that will take out money from risk asset class. And we've seen FI flows have been negative. In the last 1 month, we have seen a huge outflow from foreign institutional investors, almost like $4 to $5 billion of outflows. And that has led to the correction in our markets. I mean, it's not only our markets or Sensex, it's been across the world. US market has corrected, the Asian markets have corrected, the European markets have corrected. So it's more linked to the correction in the global markets, what we are seeing. And also the fact that inflation and other factors are slightly worrying the markets which are there. But I don't think it's such a big worry, right? It's just a transition which the market is making, as I said, right? From a very accommodative central banks, right, to a slightly more central banks which are turning a bit more hawkish. So that's the transition, and that's why we're seeing this correction in the market. I don't see a very deep correction in the market, but I think a 10, 15% kind of a correction is probably a decent correction, a healthy correction, okay, which is required for the market to get the foundation to make the new high, right?
All right, the questions keep coming in. This one's from Gyan Prakash. What are the 2 sectors that one must have in the portfolio now to get healthy returns by the end of 2022? Your thoughts on that, Mahesh? You had explained to us some of the sectoral preferences you had given. Anything to expand? And as Gyan asked, 2 sectors that you have to have in your portfolio. So what would those 2 be?
So as I said, banking financials look good, okay, though because as I mentioned earlier, credit growth is picking up, NPAs are coming down, right? And the valuations there in the sector are also fairly okay compared to the long-term average. It's not too expensive. So that's clearly one sector, and you can play that through the banking and financial services fund. I think that's the best way to play, because it not only plays banking, financial services, but the whole gamut of financial services, including insurance and asset management, which are also benefiting because of financialization of saving and the move towards more protection, right? Health cover or term plans. So that's one sector clearly I would recommend. Apart from that, I think for investors who want to be slightly more risk or steady return, I think India will continue to be a consumption driven economy, and the consumer sectors, which are the oriented sectors, which are there, while they have got impacted because of the COVID, and we have seen slowdown in the rural consumption in the last year, but I think there will be steady growers there, right? I mean, you would see a steady growth there, a less amount of volatility over there, and there are good quality companies in that space overall, the consumer basket, and more so I would say the retail companies, okay, which are there, which are coming out now, and the post pandemic, I think you will see a kind of retailers or individuals going out, okay, retailers, and probably spending more. So that should benefit the retail companies in this calendar year, is what we think. So I think these two sectors are one I would say one can definitely look at over the next couple of years.
All right, Mahesh. Our final question comes from Rajat Seth. He asks, what is a business cycle fund and how is this fund different and where can it fit into an investor's portfolio? Your thoughts?
So the business cycle fund, as the name suggests, it plays the various cycles. As you know, there are cycles in the economy which are there, right? Which is expansionary phase of the economy or recessionary phase or the growth phase of the economy. So this fund tries to understand which cycle are to be there in the economy, right? So there is a business cycle and there is also a market cycle also which is there, and accordingly decides which sectors to invest into depending on their outlook over the next 1 or 2 years. So in essential, it is a fund. It is a kind of a diversified fund. It invests across sectors. It invests across market capitalization. The only difference is that it tries to understand at which cycle we are there in the business, and on that basis, which sectors will do well over the next 1 or 2 years, and try to be slightly more overweight or more concentrated in those sectors. So it's a more top-down approach, right? You take a top-down call across the sectors rather than more of a bottom-up call and getting those sectoral calls right. So that's how this fund is, and this is all pervasive theme, right? There's always some sector which has been doing well at any point in time, right? I mean, one last year or 2 years back, it was the IT sector which was doing very well. Now it is some of these banking or the cyclical sector which have done well, right? So you keep on rotating across sectors and try to get the best sectors which you think will do well. And in that sense, it is a kind of an all-weather fund, right? It's not necessarily a thematic in which you need to invest. It's a more closer to a diversified kind of a fund, but with a slightly more concentration, and in that sense, a slightly more risk profile will be slightly higher there, right? For the investors who have a slightly higher risk appetite, can look at the business cycle fund.
Need a wealth of information shared by you for all the investors who are watching, who can consider what you've said and see how it fits into their idea of investing and the way forward for their portfolios. But as we look to conclude our conversation, our fireside chat, Mahesh, your final message to investors, what would that be? What would be the key takeaway of your message to investors?
So I would say that, last 2 years has been a very, very good run for the markets, right? A lot of new investors have come into the market and they have had good returns, and they would have thought it's very easy to make money in this market, right? You've seen that. But I think, people have seen the markets, and you and me have seen markets for many, many years. We've seen there is volatility, there is risk. And market this year will be much more discerning and pricing for risk much better, right? When there's enough money which is floating around, the risk goes out of the window. So you have to be much more careful this year, or even otherwise, right, going forward for retail investors, and look at the fundamentals. Okay, don't just go by stories. I think that easy money which was there is behind you. I think you have to really understand the risk, understand the fundamentals before you invest. And I think the best way to do that is then to a lot of people have gone directly into equity markets and made money, but you can also burn your fingers, and we've seen that, right, when the market's correct. So I think whatever returns you have made, it's also to protect those, right? And the best way to protect that is to really ensure that you put them into good quality stocks, and also give it to money managers, right, who know where to put in that money. So I think uh, uh, be much more guarded. Okay, understand the risk, and as I said, somebody said here, right, stick to your discipline. Right, you get carried away in a bullish market and try to over allocate to equities because you think that that's where only the returns are being made. But yeah, equities are volatile and there are periods of drawdown which could be there. So stick to your discipline, and I think otherwise I think things should be fine.
All right, sense and sensibility, two keywords which keep recurring rather, when it comes to investing for your financial benefit. But we've run out of time. On that note, it's time to conclude our fireside chat with Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life Mutual Fund, on the takeaways for retail investors from Union Budget 2022. Thank you so much for joining us, Mahesh. It's time now to move to the next item on the agenda for Nivesh Mahakumbh 2022, and that is a panel discussion titled Passive Investing and Winds of Change. Well, the Indian markets have been witnessing steady inroads in the realm of passive investing. The passive investing landscape has been abuzz with activity, with new and old fund houses joining the bandwagon. Now, a recent study by the National Stock Exchange revealed that between March 2021 and December 2021, the total assets under management of ETFs rose nearly 40% in India to over 4 lakh crore rupees. Now, while the last couple of years have witnessed a steady spurt in passive funds with more and more retail investors flocking to them, India still has a long way to go in the arena of passive investing, considering how popular they've been in some countries, especially developed economies. So our next panel discussion will delve into the increasing popularity of passive funds in the investor community. And to explain more about that, we have a stellar panel joined by Kaustubh Belapurkar, Director of Fund Research at Morningstar, Kanika Agarwal, co-founder at Upside AI, Jaideep Mehta, CEO at Mosaic Media Ventures Private Limited, and Abhishek Singhal, Chief Manager at Birla Sun Life Asset Management. Thank you, everyone, for joining us on this conversation around passive investing and winds of change. So let's get some opening thoughts. Kaustubh, we'll start with you. In the last few years, the passive fund segment has seen a significant spike in terms of interest in the investor community, as well as the volume of assets under management. So what, in your opinion, could have spurred this shift?
Sure. Hi, Gautam, and hello to all my fellow panelists and the investors on this webinar. So, Gautam, you're right. When you set the context, saying that passive has really seen this increase in AUM, I mean, you put some numbers out there: 40% growth in ETFs, and clearly, a couple of things have happened, right? So, one is, you've seen individual investors. I mean, traditionally, it was the bastion of pension funds and EPFOs of the world that invested into the passive funds and the ETFs. But over the last couple of years, you've seen retail individuals, HNIs, who have really been coming, to invest in passive funds. And so we've seen a large increase in the retail assets in this. And there are multi reasons as to why that's happened. I'll just lay them out, one by one. One is obviously when you look at equity investing, there are a lot of new investors coming in. We know that the last few years have been an interesting polarized market, especially the years of 18, 19, 20, where active funds in a sense have had a little bit of a tough time as compared to their passive peers. So with the advent of new investors coming in, they are looking to, if I want to take an equity exposure, I don't have the wherewithal to decide which active fund to pick and stick with it. Why would I stay out of the market? Let me buy a passive fund, right? So I think that is one change that's clearly been happening, and we expect that would continue going ahead. The other interesting bit is international investing, right? Indians have finally warmed up, started to move away from that home bias and started looking at international funds. And I think one interesting piece of the pie is, you have a lot of passive sort of, funds, international funds through the ETF or the fund of fund route, which investors can buy, right? You take exposure to the NASDAQ and other popular indices like that. And I think that's the other route which has really increased the interest in passive funds from an Indian investor's context. The third and a very interesting development which has happened over the last few years is fixed income passives, right? We've seen a fair bit around, the government obviously taking steps in terms of, be it the Bharat bond or, a lot of funds that have come around state development loans and PSU bonds. And I think that's another interesting element where, given that interest rates have, been at the lower end, people are not sure of, I don't want to take credit risk. I want to expose myself to limited interest rate risk. I think passive fixed income funds have really played out. So I think these are the three kind of key mega trends that have happened, in terms of why that shift towards passive, the increase of interest in passives from individual investors.
All right, Costa. Thank you so much for outlining the clear factors which have encouraged this shift towards passive. Although when we talk of, say, passive fixed income products, it is an interesting time considering where interest rates are supposed to be headed from here on. And as I was discussing with Bhupesh earlier, 10-year bond yield of 6.88% gives you a pause for thought. But moving on, Abhishek, we've had this discussion on passive investment, but to outline for our investors and to recap what you've always said, in what ways is the passive investment strategy more beneficial than the active one? Your thoughts on that?
Yeah, so good afternoon, everyone, and warm welcome. So, Gautam, as we discussed earlier also, and as Kaustubh outlined, the last few years have already seen a lot of investors realizing that you need to have exposure to different asset classes, and at the same time, you also need to look at the cost of investment in your portfolios. Now, given the fact that passives in most cases are index-hugging strategies, and they generally just deliver market returns or slightly over or under that, the biggest benefit of the passive investment approach is the transparency and simplicity. There's no black box about passive funds. You don't have to really think through for understanding the strategy. Rather, in case of active funds, it's more like a black box where you have to really follow the fund manager's style, study the portfolios over time to understand the strategy, and still be subjected to human error. In case of passive funds, the error is only what you induce in your own portfolios. Given the fact that most of these are very, very low expense products, it constitutes a very, very large saving for the investor. Just for an example, a typical index fund will be priced, a direct plan will be priced in the range of about 15 to about 30 basis points on an average. And in case you're looking at a fixed income product, it might be even lower. In case of active funds, the direct plans will be somewhere between 70 to 105 basis points. It's constituting about, easily 50 to 60 basis points on the minimum, and then more. With this money being reinvested in the strategy, clearly the benefit is for the investor. And the third and very, very large piece of growth that we've seen over the last few years is for institutions and for larger investors like HNIs, family offices. Passive funds, transparent index tools at low cost. They're basically like a Lego set for them. They want to build a portfolio in a certain way, they can do it. They want to, change it over a period of time without much churn, without inducing cost. They can do that. So for a variety of investors, with low cost, low churn, it tends to be a very, very, very effective tool in the portfolio, especially for investors who are new to market or who are conservative investors. This is a brilliant tool to actually enter the market, wet your feet, and then see if you want to take on more risk.
All right. In a sense, they're training wheels for those who are looking to enter the market and wonder about risks and see how to make that first step. Fair point. Point taken. That's the outline of passive investment strategy and how it's more beneficial than the active one. Let's move on to Kanika for her thoughts on taking the passive fund route for, say, getting international exposure of your portfolio. Your thoughts on that, Kanika? Kanika, if you could unmute yourself.
Hi. Okay. Sorry about that. Hi, everyone. Very happy to be here. So two parts, right? One is the shift to passives is not something that's new. When you look to the West and, India lags a little bit in terms of product development, there has been such a clear shift away from humans into rules-based investing, right? Globally and, particularly in the US, you look at retail tickets, less mutual funds, more ETFs seems to be the way forward. Even at HNI ticket sizes, top 5 hedge funds in the world are also all quants now, right? Which are rules-based products. So that theme of rules-based investing is here to stay. Now, active and passive are two different sides to that coin, but this is one overarching umbrella that we are seeing, and that's why at Upside those are the kind of things we ended up building. Now, specifically on international exposure, I think it's very important that people start with passives, right? I think Kaustubh was mentioning how it's important to take international exposure. Absolutely right. Currently, no matter how diversified you have one very large risk, white elephant India risk that you're sitting with. Important to diversify away from that. Get US, get China, get Taiwan. Lots of different interesting products being offered. And now, once you say, "Okay, I want to go to the US," how do you decide what to get in the US, right? I think Buffett, in his most recent annual conference, was talking about this. In the 20th century, auto was your hottest sector, right? Everyone had to get into auto. After that, there are some 2,000 defunct companies in auto, right? End of 2008, there were only 3 auto companies. So how are you going to pick your auto winners, right? Just deciding that a sector is hot is not a good enough way to decide to invest in it. Which is why ETFs are such a great place to start. Like you said, training wheels and whatnot, especially going into foreign markets. So that is to us a very, very strong belief. One is you need to diversify away from India a lot. 2, you need to start looking at other geographies, and ETFs are such a beautiful way to do it. So extremely bullish on that approach.
All right, considering all the positive points I've heard from Kaustubh, Kanika, and Abhishek, I again wonder why did it take so long. So let me get Jaideep to respond to that. Jaideep, as I mentioned, compared to its Western counterparts, where the passive fund segment is still very well established, India still has some catching up to do. So I want to hear from you. What could have been the deterrence, and how can fund houses change that?
Hi, good afternoon, everyone. Thanks for having me on the panel, first of all. I think there's a couple of reasons. One is, let's say, a positive for the US. You've got to remember that, the whole idea of passives was the brainwave of one person originally, the founder of Vanguard. And from there, it kind of grew and kept growing as index investing caught on and so on and so forth. And then over a period of time, passive funds tended to outperform many of the active fund managers as well, which then created a multiplier effect. In India, there has been no such single trigger, so to say. I think the other thing is that, if you see the push that the industry itself has made, and indeed the messaging from the government, a lot of it has been around just attracting people into the stock market, with the highly successful sort of Sahi Hai campaign and the constant reminders from SEBI about the goodness of investing in stocks and so on. I think so. We've got a first wave, and it's worked beautifully. And my congratulations, to my colleagues from the industry for that. I think now, as investors get more and more used to different strategies, some of the other panelists have spoken about it. You will find that some part of their allocation will end up in passives. And then over a period of time, passives will have their place in the sun, as will actives and other asset categories. So those two, I think, factors are probably the reason why it's taken a little bit of time to take off. But I think there's, should I say, roseate on brighter days ahead here.
All right, brighter days ahead, an optimistic outlook from Jaideep, and we look forward to when it becomes a sort of a regular part of the portfolio and becomes a regular part of financial strategies for a lot of investors. But on that note, Kaustubh, what kind of time frame and goals are passive funds most suited for? Let's get down to the brass tacks. Say the investor is sold on the idea of passives, but wants to understand, from a perspective of time frame and meeting financial goals, where does it fit? Your thoughts on that?
Sure, Gautam. And I think my fellow panelists touched upon a lot of important points that the industry has been developing, for the last many years now, and I think the last couple of years really been pivotal in terms of even passive fund offerings, right? That traditionally we've always had our standard broader market indices, but the last couple of years we've clearly seen a lot more come. Like I said, fixed income. We've seen a lot of thrust in the last few years. International ETFs have only grown, and we've kind of been kind of deepening sort of say commodity ETFs through regulation. So I think a lot of good strides have been made by both the regulations and the industry participants, right? When you think about the bouquet that's available, and obviously there's a lot more scope for expansion. But I think it's an interesting mix, right? I mean, you can, for an investor, you have something as easy as a liquid ETF that's also available if you want to park money away for very short term. You need that, in just a few days or a week, 10 days. So that's an easy sort of thing that's available to an investor, all the way to your diversified sort of bond, equity funds or bond ETFs, which can really be used for various different time frames, right? So let's give an example of, say, the fixed income funds, which typically come, and most of these passives are with like a target maturity. So as an investor, I can look to pick a fund which I'm comfortable parking my money at today's yields, with a certain time frame in mind, where I know that I will, I'll minimize the amount of credit risk given the mandate of the funds and where they invest. I know upfront what's happening, and also because it's a maturity at a certain point of time, my interest rate risk is pretty well mitigated or minimized, right? So I think that's an interesting way of looking at, from, like I said, liquid funds for extreme short-term parking to going up to, depending on a time frame, even 1, 3, 5 years, depending on a passive that you can pick. On the fixed income side, you can buy that, right? Then you come to your commodity and your equities. Right now, commodities, we know that traditionally we've been, gold has been a very popular asset class that people have had in a physical format, but there is merit in using that as a portfolio diversifier, as risk diversifier. When we've seen there's a risk off trade globally, it plays a good risk diversifier in your portfolio, and gold ETFs are a brilliant way of playing that, right? And then when you think about ETFs, your equity ETFs, which is really the bread and butter right now in terms of constitutes the largest assets in the industry. Again, it can have multiple roles within your own portfolio. I would say it should be a core part of every investor's portfolio because, like we said, if you're looking for various goals, retirement or building for your children's education or any sort of goal which is long term, and when I say long term, ideally 10 years and more, but even 5 years plus in some of the broader horizons, broader market indices is okay. You can really use that through a passive index fund, more diversified one, because that can really help you, not worry about, how's the fund manager doing? Is there a change in manager? Is there a change in style? Really look at, is there underperformance? It's almost like a fill it, shut it, forget it in that sense. You buy it and you just hold it for your time horizon. Then there's that last bit of, the sectoral or the thematic ETFs that come in, right? And that's the interesting bit where a little more savvier, nuanced investor, he or she wants to take an exposure. I think in the earlier session, Mahesh spoke about that, there are, sector rotation happens. And if there is an investor who can take that call or is willing to put some money on the table for a certain part of the portfolio, I would say more like a satellite allocation to a portfolio, can think about, looking at some of the sectoral ETFs, for instance, for taking exposure to, say, a banking or a healthcare or IT. But mind you, the risk in this is a lot more, given that, like we said, sector rotation. So you need to be a little more nimble in your approach and only take that as a satellite allocation in your portfolio. So I think the passives, I'm sorry, I forgot to mention international ETFs, and how can I not talk about that? That's the other bit, right? That moving away from home diversification to international diversification can really be done through that space obviously is has grown quite significantly. There are some challenges which we'll probably talk about in terms of limits on the AUM that they can manage right now given the regulatory constraints. But broadly, I think that's another interesting way of building that. So I think a reasonable gamut of offerings is there. This is only going to grow. But from an investor, from a day to long-term planning, you can really get a lot of ETF offerings that are available to investors right now.
Range of options available for investors to diversify and make sure that that product portfolio reflects a sort of a global economic picture, and it has insulated pockets which helps them stay in the market for the long term and make sure they rise when the markets do. But when it comes to returns, even the bravest of investors, their hearts can go aflutter. Abhishek, many investors, they've shied away from passive investing earlier, owing to the perception that returns pale in comparison to those generated through active investing in the long run. We've debated on this as well as to how the actives, the fund managers can sort of boost alpha from the short-term periods and make it as a far more attractive option than passives. Your take on what's going on currently? Abhishek, your thoughts on that?
Yeah, Gautam. I'm sorry, I was on mute. So Indian market has always been, three steps forward, two steps backward. So 3 years you'll get fantastic returns, 1 year a flat return, and the fifth year perhaps you'll have a very very difficult period. And Mahesh was just mentioning in the previous session that market is more discerning now. One has to be very very careful about what stocks you get in, what sort of pricing is happening in the market, what sort of sectors are you going to get in. So, given that sort of a backdrop, in a broader portfolio, one has to actually see what are the right spots to get in. And as Kaustubh mentioned, now there is a reasonable bouquet of products which is available in passives. If you were to actually look at performance of these passive products versus their active peers, there is also a fair bit of research which is available, which proves that over a longer period of time, this outperformance is quite challenged. In as markets become deeper, as they become more evolved and developed, beating a benchmark, you it's not sort of taken for granted. There was a decade of 2000 to 2010 when we never even used to think about what is the benchmark. The benchmark was the average performance of the peer set. In 2000 to 2015 maybe the benchmark started becoming more relevant, and in the last 3 years perhaps, now if you were to look at the most popular report out there, which is PIVA report, 1 year, 3 year, 5 year, even up to a 10-year period, the top performing idea is an index fund. 80% plus active funds underperform their benchmarks. It's not a it's not a hidden fact anymore. And with all my colleagues here and elsewhere in the digital side, the explosion of information that has happened, investors are now even more aware of the fact that it's not active security selection which gives you returns. It's actually your asset allocation which explains more than 90% of your portfolio. So using passive products like ETFs as tools to build your portfolio, build the right asset allocation, you can actually generate far more stable returns, lower risk, and maybe even outperform markets over a period of time. And clearly, if you were to see the numbers which are now starting to happen, passive industry is growing at more than 60% per annum over the last maybe about 3 to 4 years, and hopefully the trend will continue. While the broader industries still continue to grow at 20 and odd. Now, if you, the wider benchmark to look at is actually the new folio edition. And recently, a data point has come in from Amphi that ETFs have now become the fifth largest in terms of investor folios, displacing mid-cap as a category. So the point that I'm making is that investors are now, thanks to the digital revolution, becoming more aware. Decision making is becoming easier. I would tend to believe that the past where investors used to focus only on returns, maybe even going forward, they will focus on returns. But I think risk is now starting to play a bigger role. Asset allocation is becoming more prominent, and a wider bouquet where people want to be in control using these tools as part of their portfolio is going to become more relevant.
All right. And your response to some commentators saying that, passives have removed the fun out of investing, considering it's on autopilot. Your thoughts, Abhishek?
One can say that it's removed the fun out of fund managers, but I would still say that it provides ample room for creativity for investors. You can use passives the way you want. You have ETFs, you have index, you have FOFs, and you have now wider asset classes. Earlier you used to look at only Indian equities, a large cap, mid cap, and a small cap fund, and you are done. Today you have an SDL in fixed income, you have a liquid fund, you have thematic ETFs, you have sectoral strategies going on. You can build the portfolio the way you want.
All right, DIY for investors. Kanika, let me get you in. Considering so many options have been listed out, from exchange traded funds, fund of funds, index funds, so many options in the passive funds category in India, it can be tricky for investors. So, what are the things that investors should keep in mind when choosing a passive fund? Your thoughts on that?
Yeah. So even before that, you said it takes the fun out of investing, but just investing is not supposed to be fun. The more boring it is, the better. I think that everyone just forgets. In the last 2 years, everyone sitting at home and thinking this is a game. Please let it be boring. So that was just sorry, I had to say that. But back to, what are you supposed to look at? So two parts to it. One is actually, what are the things you look at when you buy an ETF or choose a house? Four things. Look at the average daily traded volume. What you're trying to solve for when you're choosing an ETF is essentially how liquid it is, right? So how easy it is for you to buy it, and then how easy it is for the ETF to then buy the underlying securities, or issue those ETF units to you. The other is, of course, tracking error. All of this is part of the same basket of, is there sufficient liquidity within the underlying. So when you do, for example, a Nifty ETF, that's much, much easier to do because Nifty stocks are very easily traded. There's enough liquidity in there. There's a lot of depth in that market, which is why you don't find that many Nifty 500 ETFs at the moment, right? Because liquidity dries up very quickly the lower you go. So average daily traded volume within the ETF. What is your tracking error? That's the second one, which is how closely does the ETF mimic the index, right? So the idea is that when you're saying you're buying a Nifty and Nifty does 10% this year, what is your ETF doing? Is it doing 9.9 or is it doing 7? If it's doing 7, it's a very, very poor ETF. It's not able to track its index correctly. And the third thing, of course, is cost. The whole idea of buying an ETF is to be able to at least generate, base equity returns. And there is no rocket science here. You're buying an index, your cost should be the lowest. So in any case, in the US, we've seen a race to the bottom. ETFs are now free. But I think we're a little far away from that because ETF houses, Fidelity, etc., have different ways to generate money outside of just charging customers. But it is a race to the bottom. It will increasingly go down. It is very important to see what is the cost you're paying on an ETF that you're buying. One, and two, continue to track it. There is a little bit of a bait and switch happening at the moment where fund houses are doing NFOs at cheap costs, and then 6 months later suddenly the cost is going up. So continue to track how much you're paying for your ETFs. That is it's critical. You should not be paying too much, right? And lastly, I would urge most people to start at least thematically or in different pockets, start looking at ETFs. For us, if I wasn't running upside and using rules to invest, my large cap allocation would be ETFs. It is very, very difficult to find alpha within the Nifty. There is no reason to be paying someone to be buying HDFC Bank for you, right? Just buy an ETF and make sure that that's really how you're taking those kind of exposures. And it's not just ETFs. There's a whole bunch of different products that end up doing some version of active ETFs. Small cases are around now and doing very interesting things on creating baskets or themes around which you can invest. So that allows you to have a little fun and say, okay, maybe I think after this budget, I want to buy an infra sort of small case. So you can create baskets and buy different types of baskets. But again, stay away from too much active investing and try and go closer to themes or indexes.
But that's exactly the trouble, right? Because, for the braver kind of investor, considering the wealth of investment options now available, they can kind of go a step ahead and invest in investment products which are a bit, how should I put, off the beaten path, and they offer you some unique value propositions. The issue is, from a returns picture, if you know the risks, sure, you could go ahead, but if you don't know the risks, then you're in a bit of a trouble, right? Because peer pressure has always been a part and parcel of the investment culture. If you see a bunch of people, say, doing small case investing, you will run away and do that. Any words of advice, Kanika, to those kind of investors, and also words of advice to the braver kind of investors?
Right. So I think someone else mentioned on the panel how much more mature the market has gotten over the last couple of years. I'm surprised. Retail is far smarter than where generally giving it credit for their buying the dip. Best investor education that's happened in the last year is buy the dip. After mutual funds, this was the best thing that people have been taught. So I don't think everyone is panic selling. SIPs are not drying up. So one is there is the investor is a lot more discerning now. Two is passives are a great way to dip your toes into investing. As we see more financialization of savings, you will see pockets where passives play a larger role, like I was saying, within large caps. Other than that, there will still be a very, very large role for actives, for people to be taking large mid-cap exposure or things like that. And then, of course, thematics, etc., active ETFs, if you will, where the braver souls will start to venture out. So thematic ETFs and small cases fall into one bucket. which is for guys who are either a little more experienced or think they are more experienced. But across the board, I think Abhishek hit the nail on the head. Asset allocation is where you need to start. Make sure 90% of it is that. Don't be overexposed. Just because you think a stock is a winner does not mean it should have 100% of your allocation, and in an extreme case. So once you figure out asset allocation, then within equity, figure out which pockets you want to take risk and which you don't. So be a little more systematic. I think that's the next stage of evolution. Everyone's made a lot of money. Everyone is very smart right now. There's nothing you could buy and do poorly in the last 2 years. So it's time to start, figuring out which pocket you should actually exist in.
All right, some wise words there. Meanwhile, when we speak of investments, how can talk of taxes be left behind? Jaideep, I'll bring you in. Could you throw some light on the tax implications of passive funds and the different kinds of passive investing strategies that you could advise?
Absolutely. Before I do that, I must say, based on what Kanika said, I'm going to go shut my small case account now. And not try
Please start. We just got on small case.
I'm joking. No, it's actually, just echoing some of the sentiments of my fellow panelists first. I think it's an exciting time to be an investor. And there is obviously a danger of going over the edge in trying to outsmart the market. But yeah, I mean, I certainly trust the experts and not try and do too much myself. I mean, coming to the taxation question, Gautam, the reality is that, you're kind of really saving on two things. I think one, also the transaction tax, right? So there is lesser incentive for the passive fund manager to keep churning the portfolio, and it's a kind of almost not inherent in the strategy relative to an active one. So there's that kind of potential saving that you can look at. And I think the other part is also in terms of the underlying portfolio. You can save in terms of actual capital gains, because again, if buying and selling is less, and there's therefore less actual realization of capital gains and more, let's say, unbooked capital gains, especially in the bull markets that we've seen in the past, past few months, past few quarters, then you can actually just sit on your cash, let it ride for longer, and take advantage of the long-term capital gains rather than get hit by short-term capital gains, for example, and then indexation and all the rest of it. So those are the two things that come to mind, where inherently, or as a model, passives would be kind of superior in terms of tax performance. And then over a period of time, of course, this then acts as a little bit of a booster to your search for alpha, right? Because all of these savings, someone talked about the front loading of costs and so on. But if you're holding them for longer, then these savings also ultimately add up to your returns here.
All right. Abhishek, anything to add to that?
Yeah, so I think from a taxation standpoint, I think passives offer you pretty similar taxation with the added benefit of savings that Jati was talking about. The fact that they empower you in terms of taking control of your portfolio, just like Kanika was talking about small cases. One needs to be just careful about not playing with it too much, because while you are booking profits, while you are buying the dip and trying to take advantage that it's gone up, it's gone down 2%, I bought it, let me just quickly book profits on 5% and get back in again. Every time you do this trade, you're actually accumulating a tax cost. And what passive fund help you do is that they automatically, as Kanika had also referred to, rule-based investing. So indexes are designed to actually churn themselves and save on that churn cost for you. One just needs to bring in a little bit of more discipline, while they are pretty much the same as your normal mutual funds. Anything more than 65% in domestic equities gives you equity taxation. Everything else is debt taxation. But at the end of the day, the more transactions you turn in your portfolio, the higher your potential tax cost could be. So one just needs to be careful about that discipline, and about the fact that you're managing your asset allocation right. If your asset allocation is going, sort of awry because of market having even maybe gone up too much or gone down too much, taking that cost of tax could actually be a small sacrifice for a bigger goal at the end.
All right. I also want to get your thoughts on this. Well, you could call it criticism by some global investors that index funds, ETFs, they're all skewing towards bigger companies, and in a sense, smaller value stocks are being neglected. Any thoughts on that, Abhishek, Kaustubh, Kanika, if that you would want to respond when you hear that viewpoint being shared across?
Personally, I think to some extent this criticism has been earned. It's right also that the way traditional indexes are designed, there is larger contribution of the biggest companies in the portfolio. But at the same time, there are these different genre of funds which are coming in, different indexing rules which are coming in, which are called smart beta. And I think that's the next step, which is going to be driving the growth for the passive industry. You have equal weight as a strategy which has come out this year, and over the last many years of research, it has shown that it actually generates some bit of alpha over the traditional indexes. While it does, traditional indexes do have their own issues with respect to what you mentioned about larger company bias. It also ensures that smaller companies or the wisdom of the market is actually built in. The smaller companies or companies which are not performing are weeded out over a period of time. I think maybe Kaustubh and Kanika can opine on this in a more evolved manner, looking at how it's happened for international and how it's catching up in India.
All right, Kanika, your response, and then we'll come to Kaustubh.
Yeah, no. This, I think it's very fair to say that when you're buying even the S&P 500, there is a unfair weight to FANG, etc. that ends up happening. So two things, at least in India, I think we have a lot to do to increase depth of market. A lot of that comes through, more trades or more liquidity that needs to come in. I'm just going to throw this out there. We need to reduce transaction costs on a lot of things that we have, right? A bunch of the STT stuff comes down. There's more liquidity in the market because more trades are happening. That is one part of it, which is increasingly markets need to be deeper. But having said that, as soon as you start to get thematics, there will be lots of pockets of very interesting kind of ETFs you can buy. So for us, for example, in the US, you can buy a pet ETF. Right? We personally own a lithium ETF instead of an EV one. There are so many different ways to play it where there are small amounts that go into different pockets, which is where this whole level 2 or more discerning investor who's going to try and figure out themes comes in. But the criticism of indices is absolutely right. And there is a little bit of indexes are broken in many ways, and that sort of translates into the ETF industry. So we need to fix that at a structural level before we address that at an ETF level.
All right, Kaustubh?
Yeah. So, I think Abhishek and Kanika really hit the nail on the head that, yes, and this push and pull that's been happening, especially with, when you look at the international context where ETF flows or passive flows have really dwarfed the active flows over the last decade, especially in the US. It has kind of led to, more money chasing those, larger capitalization companies given the construct of the indices. So I would say that criticism to a certain extent is I mean, it's definitely fair. But, when you think about it, right, that what that also allows then, you think about market forces at play, like Kanika was talking about, that you can also then delve into more thematic ETFs. Active managers can start taking bets, and that's kind of the market dynamics at play, where you will always have elements where investors will be looking at, okay, maybe your traditional passives are not that great. I want to look in equal weight, or I want to look at a value or a dividend yield, or something like that in terms of thematic play. So I think that's the push and pull, which is really a part of parcel of the market. But yes, I think to a certain extent, given how the the index creation in terms of really that top heaviness, which is not just in India but in a lot of other international markets, is going to continue. But I think the good part is at least we've seen a healthy pipeline of newer companies getting listed. So hopefully we'll get a more broader, deeper market, in the years to come. But yeah, I mean, I think that's I would say fair criticism to start with.
Yeah.
All
I'm
right.
also- sorry,
Before we come, sure. Go ahead, Kanika.
I'm also worried what happens when ETFs get too big, right? And they're essentially now how much of price action is artificial because ETFs need to be buying versus a stock being fairly valued. So because markets are so self-correcting, I can see them fixing themselves over long periods of time. But I am worried that why is the price of the stock X X? Is it because too many ETFs bought it, or is it because that's what the market thinks it is? So it's almost ironic that ETFs can bring a certain level of inefficiency to the market also, right? And we'll figure out how.
So
to
how
fix it.
can that be addressed, Abhishek, in your way? Because it's a valid point. Because at the end of the day, you end up wondering about the underlying value which is driving a particular script, and if it's about buying from a whole bunch of ETFs, that's not exactly reflecting the true picture of what's going on. So before we come to the last round of questions, your response to that, Abhishek?
Well, I think as Kanika and both Kaustubh had mentioned, it's a structural reform which needs to be taken. I think, and SEBI's been thinking about it, talking about it. There are industry bodies working on this. Uh, the way we define indexes, the way we design these rules today, there are certain caps that we create for individual stocks as well as sectors and more diversified indexes. Of course, with thematics and sectoral indexes, there is not much that you can do, but these caps is something which is a risk mitigation at some point in time. And I think with emergence of different strategies coming out with different ways of designing the same index, the smart beta strategies, I think that is something which will change the way investors have been investing so far in ETFs and in index funds. I do hope that this experience is good, because success brings in more success for industry. Smart beta over a period of time will be able to maybe even mitigate some of the perils of this traditional indexing, and bring about maybe some new ideas as well.
All right. On that note, let's get in, everyone's summary thoughts on, the way forward and what they would wish, say, regulators do to enhance the passive investment landscape in India. So, Costa, we'll start with you, and then we'll go around the table from Kanika and Abhishek and Jaydeep's perspectives.
Sure, Pavan. So I think, like we said, it's really the start of an exciting journey for passives in India. I mean, currently, when you look at data that AMFI puts out, there's just about 2% of individual investor holdings in ETFs and fund of funds, and I think another 2% in index funds, right? So it's really skimming the surface in terms of allocations from individual investors towards passives. And I think this is only going to grow and grow significantly. And I think there have been some interesting steps, obviously, the regulators and the industry sort of has been taking in terms of, one is investor education like this, which really helps increase awareness and understanding of passives. And secondly, I think the thing that Kanika alluded to is in terms of setting a liquidity framework for ETFs. Because if you want to have a vibrant ETF market, instead of investors trying to get in more index funds rather than ETFs, you need to have mechanisms where liquidity is free and easily available without much impact cost for investors. And I think that is a framework which obviously the regulators are looking into closely, and would be the next step to really grow that ETF market or the passives market quite significantly.
All right, Kanika, your summary statement on the way forward and what prescriptions you would suggest to the government or regulators to enhance the passive investing landscape.
I think it's very naturally and organically going to happen. You look at all the new mutual fund licenses that are being given out this year. All of them are to guys who want to launch passive shops, right? And there's enough venture dollar in there. We're going to see lots of change in consumer behavior, which then drives policy change. So I'm very excited over the next 3 years as more and more money is being poured into evangelizing passives, because every single mutual fund is going to have to distribute that, right? So interesting times. We don't really need to do much. The market drives the change it needs. So that would be my. I'm just going to wait and watch and invest.
You could put that on a T-shirt. The market drives the change that it needs. Wise words indeed. Right. Abhishek, your parting thoughts.
So I think I agree with Kanika that the consumer is becoming more and more discerning. They realize the money that they're spending to get what they are getting in their portfolios, and clearly they are moving towards passives very, very, very quickly. If you look at the AMFI data, from a regulator standpoint, I think they've been absolutely supportive of this passives move. They've been pushing for transparency in the industry, and they've been pushing for low cost as well over the last many years. And I think the consumer will fast track that change itself. The only two asks that from a business standpoint that I would typically have is build the liquidity framework, strengthen that liquidity framework for the industry, so that tomorrow the risk, the inverse risk of passives itself driving that inefficiency in the portfolios is mitigated at some point in time. And second is to allow more distribution. Unless you have larger distribution network available, despite being such a great product, it will still not reach the masses. Even today, as we speak, we have more Bitcoin investors in India than mutual fund investors in India. So I think some work needed there.
All right, Jaideep, let's get in the last word from you on this, on the way forward and your prescriptions.
So I think first I'll just make a corrective statement, which is my own personal view. I think we have more Bitcoin speculators in India than we have stock investors in India. 99.9% of the people I speak to who have so-called invested in Bitcoin don't even begin to understand what it is, which is a bit worrying actually. Adding to what my co-panelists have said, I think I would call, of course, I think the regulatory aspect is very important and keep costs low. The second really important piece is, I think the industry should evangelize the funds like they've evangelized stock investing overall. I think the more you do that, more you make people aware that there is this stream of investment products available that they can look at, and those who are willing to settle for market returns rather than continuing to search for market beating returns. And there's many of us who are in that boat, who are very happy with market returns. As long as they come at a low cost and relatively lower risk, then there will be an uptake and I think a net inflow overall into the industry as a result of these funds becoming more and more popular.
All right, those are some insights from our panelists on how passive investing has shaped up as an investment option for India's retail investors and where things could go from here. Wise words indeed from everyone, and I'd like to thank all of them for sharing their thoughts on this topic. Let's see where we go from here. As Kanika said, the markets will drive the change that they need. So let's hope those changes are positive for the investors in general. Thank you everyone for joining us and sharing your thoughts. Great speaking with you. I'm sure the audience has learned more on the whole idea of passive investing, and hopefully it won't be on the fringe, but rather on the mainstream. Thank you everyone for that. And before we move on to our next session, here's a recap again on the value of SIPs and how it can help investors win in the game of financial stability. So take a look at that again before we move to the next item on the agenda.
किसी की छोटी सी एक चाहत, बड़ी किसी की प्यास, बूंद बूंद भरते हैं सागर, है हमको विश्वास।
घर घर है लाखों सपने, हर सपने की एक जिंदगी, कोई घर फिर क्यों छूटे, हर घर जब हो SIP। तेरी मेरी बने हमारी, हो तैयारी जीत की पूरी। Together we can win with SIP। हट सो जर लहानगीचा, किंवा सो आजीची आशा, खरोखरी आता असेल SIP, कल्ला सगळ्यांचा आपला आपला।
తండ్రి బిడ్డకు ప్రాణం పోసే, తల్లి ఆమెను తీర్చిదిద్దే, వారిద్దరి కళ్ళకు ఆమె రూపునిచ్చే, వారికి SIP తోడిగే। तेरी मेरी बने हमारी, हो तैयारी जीत की पूरी। Together we can win with SIP। करे फॉरन मावे के पति चलावे मनपसंद गाड़ी ना 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 मी रहे इन ड्रीम बंगलो अने चार धाम दादा दादी
तेरी मेरी बने हमारी हो तैयारी जीत की पूरी together we can win with SIP wrestling பண்ணு இல்லை கிரிக்கெட்டர் ஆகு எது விளையாடினாலும் முழுமையா விளையாடு முன்னிரு எல்லா ஆசீர்வாதத்தோடையும் SIP இருக்கும்போது எதுக்கும் பயப்படாதே ಅಪ್ಪನಿಗಿತ್ತು ಕನಸೊಂದು ಮಗ ವಿದೇಶದಲ್ಲಿ ಓದಬೇಕೆಂದು ಸಂದೇಶ ನಮ್ಮದೊಂದು SIP ಯಲ್ಲಿ ವಿನಿಯೋಜಿಸಿ ಎಂದು
तेरी मेरी बने हमारी हो तैयारी जीत की पूरी
together we can win with SIP
അവരുടെ സ്വപ്നങ്ങൾ ഉറങ്ങിപ്പോയിരുന്നു സ്വപ്നങ്ങൾ അവരുടെ ഉള്ളിലൊതുക്കി സമയമായി അത് ഉണർത്താനായി SIPയുടെ ലക്ഷ്യം സഫലമാക്കാനായി
যেদিন এই বাড়িতে সে আসলো একটি প্রতিজ্ঞা সে করলো অল্প অল্প করে জমা করবে বাড়ির ভাগ্যগুলো পাল্টে দেবে ভাগ্যের চাবি বানাতে পারে প্রত্যেক বাড়ি যদি SIP করে
तेरी मेरी बने हमारी
हो तैयारी जीत की पूरी together we can win with SIP
An investor education and awareness initiative by Aditya Birla Sun Life Mutual Fund.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।
Indeed, you can win with SIP. That's the message there. Onwards to the next item on our agenda, which is a special fireside chat on retirement planning. Well, after having spent decades of your life keeping up with personal and professional commitments, retirement is synonymous with the beginning of a phase when you can look forward to being stress free. It is also that chapter in your life when you have the time to start checking off boxes from your bucket list created in your younger years. But whether your retirement dreams will come to fruition, it depends on the effort you would have put in before retiring to ensure that you have a steady stream of income when you bid adieu to a 9 to 5 grind. All too often in life, we tend to become complacent when it comes to our preparedness for life events that seem too far away in the horizon. Often, this stems from a misplaced sense of certainty of there being enough time to ready ourselves for those eventualities. Procrastinating retirement planning can not only have an impact on the quality of your life post 60, but it could also amplify the impact of any exigencies once you join the League of Senior Citizens. So, our next segment is a fireside chat on how you can be prepared for your retirement by investing, right? And to give us all the answers, we have with us Mr. Deepak Jain, who's the Director for India and South Asia at the American Academy of Financial Management. Mr. Jain, thank you so much for joining us, and we're looking forward to hearing your thoughts on a variety of questions around retirement planning, which I'm sure our viewers would be keen to know, both old and young. So let's start with what is the optimum age range to start planning and investment for retirement? Your thoughts on that, Mr. Jain?
Thanks a lot for having me here, Gautam. So, before I tell or discuss about the right age to start planning about retirement, let's discuss what is retirement, right? And will I retire? This is a question which I get asked by many people that I'll continue working till the last days of my life and I will never retire. So retirement is basically that age where your passive income is able to pay for most of your needs and most of your wants. Now the question is, will I retire is a very tricky question, because there are two types of retirement. One is voluntary retirement, where I choose to retire. But second is forced retirement, where I am forced to retire. And that can be due to health issues, due to your skills not being required any longer in the economy or not being able to produce money. And you can choose not to retire. Voluntary retirement is optional, but forced retirement is something which can happen to any one of us. And you need to be prepared for forced retirement even if you are not willing to retire. Now, coming to your question, at what age should I start planning for retirement? So, one thing is very clear in life, there are only two options: either you will die or you will retire. There is no third option. And question is, what if you do not die? Which is a bigger risk, dying early or living too long? Actually, living too long is risky, and you should start preparing for this long life, which is becoming more common day by day, by planning for retirement as early as you can. Now, many people ask me, I have just started earning. Should I start planning for my retirement at this age only? Now, my answer is you should start as early as possible, because when you are younger, maybe not married, not having kids, not having many responsibilities, you are in a better position to save. And in retirement or any goal planning, the amount of time the investment remains is a bigger multiplier than the amount of money. So you have two options: either you save small amounts for longer period, or you save larger amounts for smaller period to reach a investment objective. So, and I would prefer people uh, investing smaller amounts over a longer period of time and reaching their goals rather than doing the other way around. So start
All right.
as early
Smaller
as
amounts
possible.
in longer periods is a better option in your opinion.
Yeah.
All right. In that context, then, many investors, they still struggle with striking that appropriate equity debt ratio when planning for retirement. So, how can they achieve that? And how should investors tweak that ratio at different stages of life, in your opinion?
So Gautam, actually people think that their retirement planning ages are same. It's a single phase of planning for retirement. Actually, it's a three-phase goal, which starts with a pre-retirement phase, and then it goes to a transition stage, and then there's a post-retirement stage. And your investment and objectives are different over each stage. Now, if I ask you a question which people have is, what is the full form of ROI? Now, most of you would say the full form of ROI is return on investment or rate of interest. But actually, this ROI full form, return on investment, is for a pre-retirement person. Moment a person moves to a post-retired stage, this ROI full form changes to reliability of income. Now, at a post-retirement age, I should sacrifice returns for reliability. And this is the crux of retirement planning. So that means pre-retirement, I can go for variable income products where income is not guaranteed. But post-retirement, I have to go for guaranteed income products so that I do not outlive that income which I generate from that investment. Now, coming to pre-retirement investment, I can say go for more equities. And as you reach the retirement age, you are at the transition stage, start moving from variable income to guaranteed income. Now, here I'll also like to add that people generally think that post-retired phase is also same and the post-retired expenses are also same. No, we have categorized the post-retirement phases into three phases. And these are very beautiful way of doing it. We say the first few years, 10 years of doing it, we say go years of your retirement. The next 10 years are go slow years, and the last page is no go years. So these are self-evident. What do I mean? And do your expenses remain same, or are they same? No. These are also three types of expenses. The first is your core expenses, the survival expenses. Then second are the joy expenses, the discretionary expenses. and third is something which you want to leave, the legacy expenses which you want to leave. So you need to prepare a corpus which at least pays your core expenses, able to pay your core expenses post retirement, and maybe it would be good if it is able to pay your discretionary expenses and legal expenses also. So you start initially with more on equity side, asset allocation towards equity. In the transition phase, go to more towards the debt. And post retirement, yes, some equity exposure would be required, because not taking risk would be the biggest risk you are taking post retirement, because money would not be growing at a faster pace than you are consuming it. So the it is a dynamic asset allocation which needs to change from different phases of life which you are going through.
Absolutely. And it's a very interesting way that you put it, the transition of ROI from return of income to reliability of income, which at the end of the day is core from a retirement perspective, especially as you look at banking on living from the investments that you have made. But there's also the point, Mr. Jain, that the pandemic has caused a deterioration in the financial health of countless people, and saving and investing for financial goals that may be tricky at this juncture. So in such situations, what according to you is the right way to approach retirement planning, given the possibility of this being pushed to the back burner?
So retirement is one goal which you cannot do away with. Like I said, in life there are only two options: either you will die or retire. Question is, if you do not die, what will you do? Right? And even if you are at a stage today where you are not making enough money and you would have to choose between goals, so can you put a goal like retirement at back burner and say that my other goals, like maybe buying a house or a child's higher education funding, are more important than something called a retirement? Generally, why do people do not place or give priority to retirement so much? So I think one, it's the farthest goal which you see from now. So you say other goals are due previous to this, so I'll put more money into that. Secondly, you think that this is a selfish goal. Other goals are for children and other people, and I like to go for them. But when you board a aircraft, the air hostess says first put on your mask, then help the person sitting beside you. Because if you are not safe yourself, can you help anybody else in this world? So I would say, whatever be your financial situation, if you are able to meet your core expenses today and you have some savings, please direct it towards your retirement. Because the worst thing that can happen to you is you are alive, not able to work, and you have no money. There's nothing more scarier than that.
Absolutely. So, what advice would you give to investors who find it difficult to stay committed to retirement planning because of existing debt liabilities and loan? You outlined the fact that a longer life, view it as a risk, because at the end of the day you need to have money in your bank, even when you say you might not have the earning capacity. So, your words of advice to investors who find it difficult to stay committed to retirement planning when they see the current problems, which is existing debt liabilities and loans, and they think, first let me take care of that, then let me focus on retirement planning.
So let's see, what kind of loans do you have? Are these loans some good loans which are used to create assets that would appreciate over time, or are they bad loans used for consumption purposes? Now, having said that, it makes no logical sense that I am earning 8% on my retirement corpus and I am paying a 25% interest on my loan outstanding. In that case, I would say first pay off your higher interest loans, and then start saving for it. That's logical, right? But still, I would say that if you are into a cycle of debt where paying debt is difficult, then go for a cheaper loan, pay off the higher cost loans, and slowly pay off your liabilities and start saving for a goal which is called retirement.
All right. So as we look to wrap up the conversation, so I'll get some of your parting thoughts on the elements of retirement planning that are often ignored or undervalued. Your thoughts on that?
So first of all, retirement is more than money. People think that retirement is about money, having money at the right age. it's about having meaning. So when you start planning for your retirement, think about the post-retirement lifestyle, because the biggest problem post-retirement, apart from money, is the boredom you feel post-retirement, the the loss of identity post-retirement. So when you start planning for your retirement, the first thing you need to do is you need to envisage what would you do post retirement. And like I said, that post retirement lifestyle planning is very, very important. And without planning that lifestyle post retirement, do I know what would be the money requirement at the stage of retirement? So it's very, very important that first I decide what kind of lifestyle would I lead post retirement. And there, something which I call, you should find a purpose to your life, right? Life is much more than money. A typical person's life would be something like that. I was born, I wanted to have admission in a good school, get a good career, marry or have children, settle children, and maybe build a house, build a vacation house, and then retire and die. If this is your life, it's a very boring life. So your life is much more than only accomplishing these goals. So when you start planning about your retirement, think what impact would you leave post your life in this world? And that is your purpose of life. And if you have a purpose of life, it's always better that you start working not for money, but to achieve your purpose of life. So there's a very interesting concept which is called circle of wealth, right? I'll just briefly discuss this concept. This concept says when we start our careers, most of our income comes from our current efforts, maybe salary or business income. And very less part of this total income comes from our investment income. Now, circle of wealth says that every person has an income. When this person does some expenses from this income, whatever remains becomes his savings. And when he converts these savings into investment, it starts adding to his income. So there's a continuous circle going on. What should be your effort in this circle? Should try to maximize income, minimize expenses, maximize savings, and then convert them into income or into investment which give you the highest possible return. And if you continue doing this, this original circle which you had, which was basically funded from mostly your current efforts, it would be reversed. Now majority of your money is now coming from your investment income, not from your current efforts. And this is the stage which I call retirement. So retirement is not about an age, it's a stage in life. And it's a stage in life where you no longer have to work for money. The question is, if I don't have to work for money, and if I reach this stage where most of my money is coming from my investment income and very less comes from my current income, would I stop working? No, you would still continue working. But now there will be a difference in your work. Now you will start doing things which you like to do, not things which you have to do. And I know for sure that you can excel only in things which you like to do, not things which you have to do. So you should reach this stage, what you call retirement, financial freedom, whatever you call it, as soon as possible. So when you ask me what is retirement, it's a stage in life where you no longer have to work for money or can work for money. That means there are ways of you reaching retirement. Something says, somebody would say, I have to retire because I have reached that stage. Somebody says, I am done away with life, so I'll reach, so I retire. I don't like this life. And somebody look forward to retirement. And that is about having meaning after retirement. Second thing which I need to talk when I talk about retirement is that first ensure that your core expenses are met from your current investment. That should be your first target. Survival is more important than anything because it ensures your dignity and quality of life. Thirdly, whenever you start planning for retirement, do not ignore wealth transfer issues. Make your will, make your power of attorney, make a trust if required. And my last advice is just do it. Don't keep on postponing it.
All right. My last question to you. We have about 3 to 4 minutes remaining. Do you see investment planning itself changing, considering the wealth of investment options which have come on stream? 15, 20 years ago, you didn't have these many options to invest. Considering the flexibility that is offered to investors currently, how do you see the nature of investment planning itself changing from here on?
So previously we had something where people were relying on their pensions or other things for retirement, and they thought that. And secondly, the mortality age was very less compared to what it is today. So people could afford to retire, right? But now you are living longer, and the options, as you said, to invest are more. So what I would say, don't put all your eggs in one basket. So I would rather stand on after retirement on a four-leg stool than a three-leg stool. So try to diversify investments. But when you try to diversify investments, look at your core joy and legacy expenses. Your core expenses should be met by products which are guaranteed for life. And there, something like a annuity or a perpetual annuity products are very good for meeting your core expenses. Then once you meet your core expenses, have a adequate emergency fund, then you start investing for return, investing for growth. And there, as your previous panel was talking about, passive investment is a very good option. It's a very good option because I don't have to fish for particular investment. I can just pick up a index or a thing, a broad index, and let the money grow, because I would not like to take too much risk even post retirement. Also, while investing post retirement or any stage of life, people think age should be the criteria. I beg to disagree. For me, the criteria is time to goal. So if you are a 75-year-old person who wants to save money for your grandson's education, who is still 5 years old, and the money is to be paid after 20 years, maybe go for a 90% equity portfolio. So it depends on the goal which you have post retirement. It is not about the age you are living.
And you have to factor in inflation as well, which is a common mistake which people make, that when they assume a certain lifestyle cost, they forget that there is inflation at play as well. So while they might say, I'm happy with 3 crores as my retirement corpus, they might find that, say 20 years from now, 3 crores does not get you as much as you think it would.
So Gautam, that inflation number is basically of two types of inflation, right? Or I would say three types of inflation. One which government quotes, the CPI or WPI. One is my personal inflation number, the basket of goods I consume, how are they growing. Secondly, there is a inflation which is the normal inflation, and there is something called lifestyle inflation, right? Our lifestyle are changing, and my basket of good would change after a period of time. So maybe 10 years ago, I would not have spent money on a Ola or a Uber or maybe on an air condition, which I do, which is becoming a necessity today. So you have to factor both of them while considering inflation. And if you think your inflation number would be 4 or 5%, you are sadly mistaken. Well, at least 5% is lifestyle inflation, which would anyhow occur, and you will keep pace with the changes time.
All right, some very important advice and insights coming in from Mr. Jain, and I'm sure our viewers will find retirement planning hopefully a less daunting task with your inputs that you've given, Mr. Jain. Thank you so much for joining us and sharing with us your insights and your lessons on retirement planning, which hopefully our viewers will employ in managing their finances. Thank you so much. And with that, we come to the end of the first part of Nivesh Mahakumbh 2022. Please stay tuned for part 2 that starts in 5 minutes. Stay tuned.